Wednesday, November 20th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three stories that you need to know today.
Good morning, everyone. First up, Nvidia taking center stage. The $3.6 trillion AI chip giant reporting earnings after the closing bell on Wednesday. Investors have a high bar for the world's biggest company. Strategists at Barclays saying this is the most important market catalyst for the rest of 2024. Despite CEO Jensen Huang saying that demand for the chips is off the charts, uncertainty still does linger around demand for its Blackwell product amid production delays.
Plus, Target shares plunging this morning after the retailer cut its full-year earnings outlook. Profitability taking a hit as U.S. consumers spent less on non-essential items such as clothing and also home products. And after the company stockpiled more products in preparation of the U.S. port strike last month, which was more expensive than the company had initially anticipated.
And Comcast's cable TV spinoff. The NBC parent reportedly gearing up to announce plans to separate MSNBC, CNBC, and USA from the company to reduce its exposure to the linear TV business. More details emerged from Comcast today as the NBC broadcast network Bravo and its Peacock streaming TV business will remain with the parent company. Mark Lazarus, the current chairman of NBC Universal's media group, will become the CEO of the new company. As of right now, just SpinCo. All right, well, there was Jake Paul and Mike Tyson on the weekend, and today you get some heavyweights in the market. Nvidia reporting its fiscal third quarter results after the closing bell. Analysts, they released a flurry of bullish notes heading into this print, lifting shares by nearly 5% in Tuesday's session. The positive momentum and the sentiment provided a welcome boost to the stock, which had been bruised just one day earlier by reports of overheating issues with its flagship Blackwell chip. Now, momentum in the past month has slowed from the summer's rapid run. Shares still have risen just 6.5%, though, over the past month, compared to a nearly 60% jump since June in aggregate here. So a lot of high hopes, a lot that is going into this print in terms of expectation. Larger question of what they will signal about demand for the future and how long run they see that showing up in some of their purchase orders as well.
Yeah, the forecast is certainly going to be critical within these results. When you take a look at, and we have a chart to show just the dramatic growth that we've seen in Nvidia's revenue here over the last several quarters. And going back to Q1, it says Q1 of 2021, but I want to start where we're looking at Q1 of 2024. And you could see this stepping stone really just straight to the upside. You're looking at Q2 here of 2025. You're looking at those expectations just in terms of what we are going to see here this afternoon. It's set to bring in $29 billion for the quarter in its data center segment alone. That's about a 100% jump from what we saw a year ago. Gaming revenue is expected to rise 7%. Analysts anticipating gross margins to hit 75%. So again, when you take a look at the dramatic growth that we have seen on the chart there on the screen over the last several quarters, that really puts in perspective just how quickly and how rapidly Nvidia's business has grown. Of course, when you go into this print, a lot of that focus is going to be on the Blackwell chip specifically, what exactly demand looks like there, any sort of hints of delays. Of course, that has been an issue that has been a little bit of an overhang here on the stock most recently. But again, there has been a most recent report coming out earlier this week from the information saying that AI chips have run into problems with overheating servers, could potentially hold up some installation here within the data center. So again, any thought or any further detail on that will be something analysts will be closely watching.
Yeah, one last thing here. It'll be interesting if Jensen Huang or if the leadership at this company does address anything regarding President-elect Trump, of course, changeover that's coming in the White House, and ultimately how that also plays into some of their forecasts. As you look out into next year, if there are more geopolitical tensions, could that mean even more of a look across this chip space, which President-elect Trump has been critical of some of the funding going towards it, but for Nvidia, they've really tried to insulate some of their broader partnerships around the world. Could that be challenged if we were to see even more of the ratcheting higher of those tensions? That's something that might be interesting to hear for on the call.
All right, let's talk more about NVIDIA's upcoming results. For that, we want to bring in Jeff Krumpelman. He is Mariner Wealth Advisors Chief Investment Strategist and Head of Equities. I know you have been a fan of NVIDIA in the past, so here we are ahead of the results tonight. Jeff, what is your view on NVIDIA? Is it still a good buy?
Yeah, absolutely. NVIDIA is just a beast. And, when you look at the progress that they've made, 100% plus revenue growth, 100% plus earnings per share growth, and they just have huge advantages over competition right now. It's so much more than just GPUs. It's, about parallel, processing and computing. And they've got not only the hardware and the chips, but also the software and just the ecosystem, the stack that puts them heads and shoulders above the competition. So we've owned it. I do think that it's become such a large position within the passive indices. We slightly under-own it relative to its representation in those indices. And I think it's a good thing, but we're going to continue to have significant exposure to it. You have 7 or 8% positions in a stock and you under-own it. That says something about, how well it's done. But yeah, expectations are high going into this quarter, but we think that the secular trends and demand for AI, generative AI is just there. Absolutely.
As we think about how software companies have really been judged by this rule of 40, really focusing in on their growth rate and ultimately how they're able to showcase to investors as well profitability and how they can get to that 40% marker. What about for chip companies? And is NVIDIA setting a whole new standard, a whole new bar for what the rule that's applied to chip companies should look like, and what kind of growth should we see and expect a company like this to settle at, especially given some of the tough comps?
Well, that remains to be seen, right? And that's the concern, is that you've seen triple-digit level growth, probably slowing. If you look at long-term expectations, longer-term expectations, 2-3 years out, you see that slowing to 35 or 40%. But you have to kind of back up and say, okay, well, is valuation appropriate, high, cheap? Where does it fall? And it's trading at something like 36 times earnings, which gives you a price to earnings growth ratio of around 1. I think that is appropriate. And in terms of its ability to do what it's doing, first of all, the end markets are growing so strongly. But this is an innovative company that's continued to push on that front. And so 2-year cycles, what used to be 2-year cycles in introducing new chips is now condensed to 1-year cycles. And because of the software advantages that they have that are tied to this, I mean, you're looking at gross margins here that are 70%. Compare that to, an AMD, Intel type of gross margins, in the 50 to 60% range.
Jeff,
yeah.
Jeff, what happens if NVIDIA misses tonight or disappoints? What should investors then do? Should they be buying the dip?
Well, we're dealing from a position of strength. And I would think that would be, of course, it depends upon the news they come out with, but I would think, based upon the knowledge that I have, it would be a buying opportunity. And there are a lot of people that have not owned the stock. We came into the stock in the pullback in 2022 when everybody was saying, oh, my goodness, you don't want to own these companies. Go away, move away from tech and growth, because the 10-year treasury might go from 3.5% to 4.5%. And, that was kind of a laughable argument when you think about 100% revenue growth, and that really is going to be trumped by 10-year yields rising 100 basis points. So I do think it would be an opportunity. This is a stock that was trading closer to $100 a share only a couple months ago, and it looked to move back towards a previous low in the upper 90s, and now we're at over 140. So I do think it would be a buying opportunity. That's how I would look at it.
Jeff Crumpleman, who's the Manor Wealth Advisors Chief Investment Strategist and Head of Equities. Great to have you here with us this morning.
Thank you. Appreciate it.
Now time for one of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Let's get to it. TGT, Target, plunging today after missing third quarter results and both on earnings and revenue expectations and slashing its full year guidance. Saving grace, perhaps. The holidays may have started decently. Yahoo Finance Senior Executive Editor Brian Sozzi joins us now.
I'm a senior edit executive. Well, I'm getting old, man.
Look, you're a senior millennial.
Got a new title to
We'll
start the day, you know?
Same guy, though.
Yeah, same guy. Yeah, you're great.
Well, who's not the same company? It's Target, guys. Yeah. I mean, just like talk about a U-turn there. 3 months ago, we got on Yahoo Finance, talked about how there was a turnaround brewing at Target because they were slashing prices, people buying groceries. This quarter is the completely different vibe from Target. And going through these results, I think there's three things investors need to know. First up, or things I just didn't even like, same-store sales for Target up 0.3%. Not good in the context of a company trying or pitching or hyping a turnaround just 3 months ago. Also, compared to Walmart, Walmart U.S. same-store sales up 5.2%. Of course, the company reported their quarter results yesterday. Gross profit margin for Target down. Gross profit margin for Walmart up. Sometimes analysis and stock picking is just that simple. Which company is doing better on those key line items? Walmart continues to do it. I would add Walmart U.S. inventory down, Target inventory growing faster than sales. Not a good thing there. The win goes to Walmart. And last but not least, just the tone around this quarter, guys. Let me unpack it this way. 3 months ago, Target came out, raised its full year earnings guidance to $9 to $9.70 a share. Ahead of that report 3 months ago, they were at $8.60 to $9.60. This morning, after this earnings miss, they're now at $8.30 to $8.90 for the full year. So they're below that original guidance range they had out there about 3 to 6 months ago. Overall, not a good quarter for Target. I think it shows product misses in the apparel department, consumer weakness impacting the home goods, and the blunt reality of this. Target just does not sell enough fresh food. And guys, if you go to a Walmart store, some of these upgraded Walmarts, you walk in there, they have a deli slicing counter now. They're baking fresh bread. You can do your whole shopping experience inside of Walmart, and that's what people want right now. I'm not saying Target sells bad things, but you walk into your local Target, you can't do all your grocery shopping. That's just the bottom line, and that's why I think Walmart is winning massive share. And look, I just got a note from the folks at Citi. They're downgrading Target shares. I mean, they may have wanted to have done that a couple days ago, but they said Walmart is gaining a lot of market share, and this is what we talked to John David Rainey a little bit about yesterday, CFO of Walmart.
Yeah, it's so interesting here when you stack up Walmart to Target. Obviously, Target at a disadvantage. I'm curious, is this more of a Target-specific problem, or are we going to see some of the pain here that clearly Target is experiencing and some of the other retailers that have yet to report?
Target does well when the economy is doing well, and people have a little bit more money in their pocket to buy that cool-looking T-shirt in the apparel section, or that flower pot from the home goods department.
I have too many of those.
Right? We all do. Or that really new candle that they always seem to come out with, like these bowl candles. But anyway, that's just a me thing. But I think Target has to have a little bit of a philosophical or come to Jesus moment, where if they want to sell food and they really want to go toe-to-toe with Walmart, they have to start busting outside, knocking down some walls in the store and start selling more fresh food. But in order to do that, you have to have the supply chain, you have to have the vendor partners, but you also have to think like, all right, yeah, I sell apparel and home goods, and that's what we're known for, but like I need to sell like a rotisserie chicken. And like Walmart sells great rotisserie chicken, so does Costco. Like, how do I get in on that business and get people buying rotisserie chicken from my store? And when they come in, they'll buy a piece of apparel, and then my same-store sales are great, and I don't have these earnings crashes. Like, that's how it goes. It could be that simple.
I just want to know, what is your candle to Sonos speaker ratio?
Never would have pegged you as a candle guy.
I am a candle guy.
Are you a 1-to-1 Sonos speaker to candle ratio?
The thing is, like, I buy these candles, guys, and I don't use them. Like, you smell them in the store, and they smell so good, but like, you just stock up on your house. Like, and it's just, actually, speaking of candles, let me just keep the holiday vibe going, because I'm in the market for a good holiday candle. We talked to, of course, Walmart CFO John David Rainey. He told Yahoo Finance the holiday season was off to a good start. That's what I heard from Target CEO Brian Cornell on a media call, but here's what Rainey told us.
It's off to, I would say it's off to a good start, in line with our expectations. It's day to day. Some days are a little behind our expectations. Other days are a little bit better, but overall it's in line with our expectations. And look, our sales guidance for the fourth quarter was 3 to 4% up. So that's a pretty good indication of how we're thinking about the holiday season overall.
Tie it all in a bow. If you're an investor on the Yahoo Finance platform and you're looking at the stock chart year to date, 1 year, 2 years, the bottom line is this: Target's in the penalty box, and it's going to take a couple quarters of sustained improvement in same-store sales, profit margins, getting inventories more normalized for this company to re-excite investors. With this quarter today, there is a bit of I would say, a crisis of confidence in that investor base for Target, especially after they came out 3 months ago and said things were improving. Now to have a really completely different tone, come out here and cut guidance, I think they've lost a little bit of credibility.
Certainly have. Take a look at the stock price. Shares off about 17% ahead of the open. Sauce, thanks. Keep it right here on Yahoo Finance's Morning Brief. We will count you down to the opening bell on Wall Street ahead of Nvidia's results after the bell. Plus, we'll take a deep dive into the AI chip giant's numbers and what we can expect for Blackwell demand. Plus, we will have more on Target's numbers and the outlook for other retailers. We'll discuss that and much more coming up on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. That's all done with Yahoo Finance's trending tickers page. First up, let's take a look at Comcast announcing plans to spin off its NBC Universal cable TV networks. Now that includes MSNBC, CNBC, USA, Oxygen, Sci-Fi, and the Golf Channel. The independent company will be called a SpinCo, and the transaction is expected to be completed in about a year from now. You're looking at Comcast stock, you're looking at a gain of just about 1%. Why? Well, there's been lots of talk just about the drag that has been the cable networks, the cable business. Right now, we have seen churn. We have seen so many people, Brad, leave the cable business in favor of streaming. Now, when you take a look at Comcast, they will be holding on to Peacock, the streaming side of the business. So I don't think this is necessarily maybe a huge surprise. There's been lots of talk about what exactly Comcast was going to do with its cable networks. But when you take a look at the street's reaction, they clearly think Comcast will be better positioned without the cable network. So I was going through some of the quick analyst commentary here out this morning, and one stuck out to me. It was actually Barclays, and they weren't so much convinced, I think, just about the strategy here and whether or not this all makes sense. They put out in a note that a standalone spinoff of the cable network business makes little financial sense and could be motivated by a desire to overcome some of those regulatory hurdles for potentially larger deals within cable. So I thought that was a little bit interesting, kind of a contrarian view maybe to what we're seeing more broadly play out on the street.
Yeah, I think that's spot on, especially as you kind of look through some of the comments that were provided within the release from the company and how they're looking at and framing this overall spinoff here. And ultimately, with some of these actions, they're trying to reignite growth and put these companies and NBC Universal on a new growth trajectory. Their words there, saying that this is going to come as a result of some of the content, the technology, the IP, and the properties, all trying to work in concert as a integrated media company. But significant effort here, and no doubt one that investors at least have been waiting to see exactly how this could shake out and how this could ultimately alleviate some of the pressure because of the positioning and the shift in consumer attention with cable right now too. We're also watching shares of Delta Airlines this morning. The company laid out new plans for new premium passenger investments at its investor day. According to the company's leadership, premium revenue is expected to exceed main cabin revenue by 2027. You're taking a look at shares pre-market. They are lower. There are a few things to really parse through, and kind of three key takeaways that I gathered from what executives are really saying right now about their forecast for the future, especially with them leaning further into premium. They've got new aircrafts that are going to be coming on board, introducing that A350-1000s. Those are going to have about 50% premium seating. And it's also just changing how people and how investors might be evaluating what premium is, whether that be on the seat and the load, whether that be on transaction type as well, and then just customizability also. And cabin segmentation, there's also going to be new segments that they're adding. They did not unveil those just yet, so we will see exactly what that looks like going forward from here. But the overall growth in some of those investments, perhaps investors just trying to digest and really see exactly what these markers mean for how much they can expect to see return to margins. They're looking to get back to about a 14%, or they said a mid-teens percentage basis of margin growth as well here.
You know what's interesting is just how much of a bet this seems to be on the millennial traveler. And I didn't really put this, I guess I didn't really fully understand just how much of this is really reliant on millennials specifically spending more, because that group right now is spending more on air travel than all other generations. About 2/3 are willing to pay up for that luxury travel experience, which clearly Delta is playing into here within some of these new format or new initiatives going forward. I also thought it was interesting just some of the commentary around the fact that their reliance here on continued reliability, the technology investments that they've been putting through, also the co-branded credit card program with American Express. That, of course, is expected to help sustain some of the profit momentum that we could see here from Delta in the coming quarters. Payments from American Express, the loyalty points to award members that should reach $7 billion by this year, $10 billion annually in the longer term. So talking about some of the growth opportunity that still lies ahead for Delta.
Yeah, financially durable balance sheet, what they're looking to build, and have some dry powder on the side as well, the company's saying. Let's also turn to the broader market here. Treasuries are reversing gains sparked by an escalation in the war between Russia and Ukraine, with yields now resuming their climb higher amid the sell-off taking hold since the election. Joining us now, we've got Nathan Toft, who is the Manulife Investment Management Chief Investment Officer and Senior Portfolio Manager. Great to have you here with us in studio.
It's great to be here.
Absolutely. So let's just kind of correlate the two together and the move that we're seeing in treasuries, especially coming off of what took place over the past few days with the ratcheting up of some of the geopolitical tension.
I think the action you've seen is pretty characteristic of risk sentiment, right? We have this broader worry that there's a potential for higher yields because of inflationary dynamics perhaps picking back up. There's uncertainty around future policy in the US. At the same time, it is reacting when it comes to geopolitical issues, and yields come down when there's a risk-off type of sentiment. So you're going to see more of this, I think, over the coming year. Our general view is that the risk-reward on the belly of the curve is actually pretty good. But the longer end of the curve, we do worry that there's some upside going into the future just because we're woefully underpricing term premium in the market. And so we think that there is opportunities in fixed income, particularly on the shorter end to the intermediate term. But the longer end, we do have some worries about higher rates in general. But at the same time, the action we're seeing in the fixed income market is pretty rational in our view when it comes to the reactions to geopolitical risk.
So what's your advice then to investors just given some of those longer term concerns?
Our view is when you think about asset allocation, and I'm an asset allocation guy, you got to think about the drivers in your portfolio that can serve as a ballast or as a downside mitigator when it comes to risk-off events. Fixed income will still serve that purpose, but we do worry that you're going to see more episodes like we saw in 2022 where fixed income correlates the wrong way with equities, as in they go down at the same time. So our argument is you need other diversifiers in portfolios, whether that's commodities as an example, parts of the private asset market when it comes to private credit and other things like that. We think there's other ways to introduce tools into your portfolio beyond just relying on long duration fixed income to serve as that downside protection.
On the other end of this too, when it is more of a risk-on appetite in the markets, you typically tend to see some of these safe haven commodities react in an alternative fashion. So where are the commodities that you would be looking to actually outperform even when there is a risk-on sentiment?
We do still like gold. Gold has been one area that we've had in our portfolios for some time. It's worked really well. We've seen a little bit of a pullback. We actually think this is an opportunity. I think realistically there is a 3,000 number on gold at some point in time in the next 12 months. Maybe we'll get there, maybe we won't, but I think we're trending in that direction. So gold is still a good idea, but I also don't think the market is pricing much when it comes to concerns in the oil and energy markets. And so we see some opportunity, even though there's concerns about China growth and other drivers of demand, we think the pricing just isn't pricing a lot in from the potential of geopolitical risk or upside to growth if we start to see recoveries around the globe.
What do you think that upside then looks like for crude specifically?
So I think crude at this stage obviously is not pricing a lot in from a geopolitical risk,
Right.
but could you price in $5 or $10 of that? You certainly could. I don't think we're going to see oil over $100 anytime soon. I don't even think you'll see WTI over $80 necessarily. But if you can get oil back into the mid 70s, upper 70s, close to $80, I think that's a reasonable expectation given the drivers on both the demand side and the supply side that we see in the market.
Do you think there are any significant moves then that the oil market should be prepared for, even considering the geopolitical tensions that we started off the conversation with, but also from OPEC as it's kind of winding up and making its own decisions going into next year too?
Well, I think you're definitely going to still see the rhetoric around whether or not OPEC will, limit supplies or add supplies over the course of the coming years. But the reality is, I think generally speaking, OPEC would like to see slightly higher oil prices. I think generally speaking, the economy can handle oil prices that are $10 or $15 higher than current levels. And so if the economy continues to hum along as it has, and we start to see some recovery or at least better growth in other parts of the world like China, et cetera, you should see some natural upside in oil prices.
Nate Tuft, great to have you here on set with us this morning. Chief Investment Officer, Manulife Investment Management. Thanks so much.
Thank you.
Coming up, we've got the opening bell for you on Wall Street. That's all happening when Morning Brief returns. We'll be right back. We're just about 10 seconds here ahead of the opening bell on Wall Street, and taking a look at futures ahead of the open. You've got the Dow futures pointing to gains at the open. On the flip side, S&P and NASDAQ looking to open the day in the red. Of course, all this action coming ahead of the critical earnings results that we will be getting after the bell today. That is being led by Nvidia, of course, that potentially could really move the market significantly one way or the other. We've got options market right now pricing in about a 7 to 8% move. But here we are kicking off a brand new trading day on Wall Street. You got Boot Barn ringing the opening bell at the New York Stock Exchange. You gotta love the cowboy hats there. And we're also kicking off the day at the NASDAQ. Taking a look at the major averages here in the first minute or so of trading. You're looking at slight gains here for the Dow, up just about 0.1%. Flipping over to the S&P 500, holding above 5,900. But again, a slight move here to the downside. We're trading just below the flat line, essentially flat so far on the morning. When you take a look at the NASDAQ, as the NASDAQ does open, we're looking at some pressure here this morning, off just about 0.1%. I would also keep a close eye on the semiconductor index. I mentioned Nvidia results after the bell here this afternoon. The Philly Semiconductor Index could potentially move pretty substantially off of those results. We're seeing a bit of a give back here this morning, off just about 0.5%. And taking a look quickly at the sector action here this morning, you got energy financials leading the way, closely followed by industrials. On the flip side, you're looking at real estate under a bit of pressure here, followed by consumer staples off just about 1%. Let's kick it over to Jared Blicker. He's got a closer look at some of the movement we're seeing. Jared.
Well, thank you, Shauna. Let's go back to the S&P 500. 24 hours ago, I was saying that the market had opened up under the election breakout level, and I'm drawing that right here. Here it is, and we did indeed open up by that level yesterday and dip below it just a little bit, but now we have rallied solidly above it, so this is very constructive. I do want to note that both the dollar and rates are jumping right now. Here's the 10-year T-note yield. You can see that's up, but critically, both of these markets have not breached their most recent highs, and so that's when I would get a little bit nervous there. I want to point out something really interesting that's happening to Supermicro. It has been in a terrible, you can't say bear market because it's an individual stock, but it has been in a really bad place. Here's year to date with the semiconductors. Let me just see if I can find SMCI. And I want to point out that it's been 169 days since it was admitted to the S&P 500. That was all the way up here. It is down 83%. Very similar thing happened to Nvidia back in 2000, 2001. November 30th, it was admitted to the S&P 500. 169 days later, it was down 83%. So a little bit of history rhyming there, guys.
Jared, thanks so much. Teeing up some of today's market activity, plus a little history as well in the trade. It's time now for today's strategy session. The post-election rally has cooled, with investors now shifting attention to Nvidia's results after the bell. Barclays saying that the earnings are more important to the market than payrolls, CPI, and the Fed. Joining us now, let's bring in Marta Norton, who is the Chief Investment Strategist at Empower. Great to have you here with us this morning. Are you in the same camp? Is Nvidia more important than the economic data? Can it add further lighter fluid to the broader rally that we've seen and 50 plus new all-time highs that have been marked for the S&P 500 over the course of this year?
Well, it's certainly more important today and tomorrow and in the near term. I mean, as we think about what's really driven returns in 2024, of course, it's been these macroeconomic factors that were weighing labor and inflation, but it's also been the AI theme. And there's no better poster child for the AI theme than Nvidia. Of course, expectations are super high. The bar is super high. So I think there's a lot of very justified nerves going into what we can see after the bell today.
Marta, do you have valuation concerns surrounding, and not only Nvidia, but more broadly speaking, the Mag 7 names?
Yeah, I think it's interesting. There are valuation concerns for the market overall. When we think about valuation concerns for the Mag 7 and valuation concerns for the market, they're related, but a little bit different. When we're looking at the Mag 7, of course, these names have run up. They've been a major driver of returns. But when we compare them to, say, the internet cycle or the PC cycle, their valuations are a little bit below kind of those excessive levels. And so if we're thinking about AI being a similar driver of change in the economy and the markets, then perhaps there is some room here for these names continue to run. That's not saying valuation isn't a risk, but maybe it's not as big a risk as it has been at, kind of a similar historical corollary.
Marta, I wonder, what is the top trade that you're eyeing going into, and as we round out the final few weeks of this year and really set our sights on 2025?
Well, here's the rub, and we're talking about valuation. If we're looking at the market broadly, there's areas of relative value, like small caps, like some of the consumer names, but there's not screaming opportunity. And so that makes this market a little bit trickier in that there's no real fat pitches. But if we're taking a look at where is the relative value and where are the catalysts, I think you can look at an area like small caps where you have the relative value cover, and then you're adding a catalyst, whether it's tax proposals or whether it's potentially lower rates, as something that can move those markets forward. So I think there's some, fundamental rationale to this idea of this broadening out trade.
No screaming opportunity. As you say that, it really kind of makes you think about why people like Warren Buffett, the Oracle of Omaha, are saying to themselves, hey, let's sit on some dry powder right now, because there is nothing super compelling to put money back into. What are the signals that you would look for to really say where that next opportunity and when it starts to arise is? And is it more policy driven? Is it more earnings driven? And what are some of the markers you would be watching for?
Well, I think one of the things that's really important to watch is the earnings trajectory. If we take a look at just what estimates have been, the expectation was for Q3 to kind of be a trough in terms of earnings growth. And we saw that somewhere around 5% earnings growth for Q3. And then kind of this acceleration out of Q3 with this broadening out trade where you're seeing stronger earnings outside of the Mag 7. And so I think taking a look at kind of how that unfolds and what that looks like with the different fiscal policies that are on the table, that could be the driving force or thrust of the market over 2025, even if you don't have the valuation argument in your favor. The market can still do well, even if there isn't an obvious place to buy.
Marta, when you take a look at the gains that you're expecting to see between now and year end and looking ahead to 2025, what is going to be that key catalyst in your view?
Well, between now and the end of the year, I think it's kind of a grinded out period. We've got a number of different forces at play. We've got the kind of wait and see moment on the policy front. And we've also, of course, got the Fed action where there's, this expectation may be moderately so for that cut to come through, though, of course, that probability is shifting as we speak. So I think we're going to continue to see this kind of, market moving moderately higher over the course of the year. In 2025, my expectation is that these macroeconomic factors that have dominated the market are going to fade a bit from the focus. And the emphasis is going to be more on the themes that we're seeing, whether that's AI, whether that's politics, whether that's the policy elements, geopolitics also playing a role, and the idiosyncratic stock stories. So you can think of this as potentially more of a normalization year relative to the macro-driven years that we've had more recently.
All right, Marta Norton, Empower Chief Investment Strategist. Thanks so much for taking the time to join us. Let's dive into Nvidia results. We're expecting those after the bell here today. Joining us now, we want to bring in Kunjan Subhani. He is Bloomberg Intelligence Senior Semiconductor Analyst. Kunjan, it's great to have you here on Yahoo Finance. Certainly lots of hype, lots of anticipation ahead of these results. Do you think Nvidia is going to live up to that hype?
Absolutely. We think this is, again, in Nvidia style, is going to be another significant beat and raise. The demand signals from their top 4 cloud service providers and hyperscalers have continued to increase. We heard them during their Q3 earnings calls, and their Q3 capex results prove that there is no slowing down in demand. But more importantly, we think the demand beyond these top 4 guys, which is the tier 2 cloud providers, which is the enterprise, the sovereign wealth, has also continued to pick up. So we again expect a splendid beat and raise.
A pickup. And how long is that sustainable for, from your own projections?
I mean, that's the big question that everyone's trying to figure out. And, until we don't see significant signs of slowing down, I think the obvious answer is that it will continue. Again, that's why the Q3 commentary from these guys was very important. I think it looks like from what we've heard from channel checks, 2025 demand for Blackwell and the backlog is sort of in the bag. So now the next question we're trying to figure out, how will 2026 look like?
Kunjan, when it comes to some of the concerns surrounding Blackwell, a lot of that was resolved last quarter, like you were saying. When it comes to, again, I guess those demand expectations for 2025, what do you think is realistic here coming from the street?
I mean, yeah, look, there were a lot of concerns, and obviously, they're moving from the chip supplier to an entire system rack supplier now. So you do expect some hiccups. one thing people forget is there are a lot of configurations. So just a concern on the, let's say, for example, the liquid cooling thermal side does not stop them from shipping in drop-in cards or does not stop them from shipping in the air-cooled version. So we think the different configs will start layering in 2025, and most of the NVL72 liquid cooled, the massive racks are going to ship a lot more in the second half.
Does Nvidia seem like it has enough of the natural resources for not just the design, but also to make sure that within the design, there's the fabrication build out that's meeting demand as well? Because that's where it seems like some of the other players are really relying on the ability for some of the chips to fall off of Nvidia's plate and onto some of the other competitors.
I mean, definitely, look, they have the first mover advantage in this specific arena, and they have been consistently at least 18 months ahead. So these sort of slowdowns does provide some kind of air pocket for others to catch up. But having said that, still the dates we are hearing, which is first half and really second half ramp, we don't think anyone else can catch up to their most superior performing solutions, which is the NVL72. And like them, most of the other players are also faced by supply constraints when you think of these leading edge nodes, very advanced packaging GPUs that they're trying to sell.
Kunjan Sobhani, who is the senior semiconductor analyst for Bloomberg Intelligence. Great to have you here with us today. Thanks so much. It's time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at Nvidia options. Hey, Maddie.
Hey, Brad. So let's take a look at what the options market is pricing in for those all-important Nvidia earnings coming out tonight. They're pricing in about an 8% move in either direction. That's going to be about $300 billion of potential swing in either direction. Here you can see those two options on this chart behind me, either a move to the upside by $300 billion or a move to the downside. Very similar to what we saw last quarter with that $300 billion move to the upside. As a reminder, that's about the size of a Chipotle, for example, in terms of market cap. So huge potential gains moving forward here. I also want to point out that the Bank of America pushed out a note this morning saying that Nvidia is expected to drive 25% of EPS growth for the S&P 500 just in the third quarter here. They also expect this earnings print to be more significant than the next Fed meeting or the next inflation print. So that is obviously a huge level of importance and significance put on this print. One of the things that our analysts, including the person you just spoke with here, have been talking about is, does the background of the growth for the company matter? As long as we continue to see AI spend from these big hyperscalers, will that outpace any question marks about supply issues or where that demand is necessarily coming from? Of course, we'll find out the answers to some of those questions later tonight, guys.
You certainly will. All right, Madison Mills, thanks so much. Coming up, the battle of the big box retailers, why Target is struggling to drive sales while Walmart is seeing growth. We've got that coming up next on Morning Brief. Disappointing results from Target today. The retailer missing third quarter earnings and revenue estimates, also cutting its full year outlook as spending remains sluggish. Joining us now, we want to bring in Michael Baker. He's D.A. Davidson's managing director and senior research analyst. It's great to have you here, Michael. We just had the stock up on the screen. You're looking at losses of nearly 20% here, just about 15 minutes into the trading day. How worrisome are these results?
Yeah, they weren't great. Weakness in the third quarter, particularly in discretionary categories. Inventory was a little bit high, and continued weakness, it sounds like, into the fourth quarter with some potential markdown risks. So, and by the way, costs were elevated. So really the trifecta, I suppose, of bad news. And it is worrisome. I think it's more worrisome for Target specifically than for the overall consumer economy. There are other retailers that are actually doing a little bit better than expected in this environment. So it does feel like the environment is weighing on Target, but in addition to that, there does seem like some company-specific issues here as well.
Given that we're in the middle of a very promotional season for sales, how much longer rather, could that play out and impact Target on the profitability perspective, especially if you see margin compression in this current quarter that we're in, and how that impacts some of their own planning going into 2025?
Yeah, the plan is to be a little bit more promotional now in the fourth quarter. I think consumers took advantage of promotions a little bit more than expected in the third quarter for Target. That weighed against margins, so they now expect that to continue in the fourth quarter. And again, as I said, inventory is a little bit high, so they're building in some markdown pressure potentially in the fourth quarter. How does that inform next year? In some ways, it doesn't really impact the long term. We think this is a moment in time right now where the consumer is getting a little bit better, but not quite there yet. As we think about the long term, and we do think that discretionary spending should come back, and that will favor Target a little bit more than in the current environment. It shouldn't really have a long-term impact, but it certainly is going to impact the fourth quarter margins.
Michael, should investors then be looking to scoop up shares on a drop like today?
I think so. It's tough right now, no doubt, but they missed the third quarter. They lowered the guidance for the fourth quarter, so you de-risk that. Stock 20% cheaper. Estimates would probably go down about 10% or so. So there's some multiple compression in there, which makes sense. The multiple should come down here. But we think over time, Target, again, not well positioned for the current environment today, but in a better environment, they will be better positioned. So this could be an opportunity to buy the shares cheaper than you otherwise would.
Michael, is this a signal that we're going to see some similar pain from some of the other retailers heading into the holiday season?
It's going to be pretty mixed. The way we look at it, particularly for broad-based big box retailers, broadline retailers, I should say, Walmart, Costco, Amazon taking share. Others are struggling. And so Target would be in that other bucket right now, just because the environment is just really well suited to the mixes of those other big three, who certainly do sell a lot of discretionary product, but also have a lot of the need-based, non-discretionary type items. So outside of those three, other broad-based, broadline retailers are not as well positioned. And
those other three are really ramping up their e-commerce marketplaces as well. How would you grade, even as we saw digital comp sales grow 10.8% in this most recent quarter, how would you grade Target's digital offerings and their ability to sell versus some of the other competitors that are also making similar investments and seem to be outpacing Target?
Yeah, we give them a B, maybe. E-commerce is good for Target relative to the total box, and it is something that they've been good at, particularly using the stores as delivery hubs. But 11%, that's not a terrible number at all. That's a pretty good number, but certainly, about half of what Walmart reported yesterday in terms of their digital sales. So good, but not great.
Michael, let's talk a little bit just about the off-price retailer, and maybe not specifically on some of these names, but you talk about some of the developments and how Target is losing some market share within the battle of the big box retailers. I'm curious, is off-price retail, is that an area that you see outperforming, or I guess what does that then tell us about the consumer and some of the pressure that we're seeing right now?
Yeah, off-price is an area that probably does hold up, better than others. Certainly better than dollar stores. Off-price does have its uniqueness in terms of the closeout product and the ability to source that and offer it to customers at really compelling values. Not something I cover currently in terms of TJX or Ross, but my background, by the way, is TJX very early in my career in their buyer training program. So I know that business pretty well. And they've always had the ability to perform well regardless of the environment. And so I think, you sort of tip your hat to the management team there and the ability to work through this environment and really any environment. But on the other hand, dollar stores, they seem to be losing share to the big three that I mentioned.
Michael Baker, D.A. Davidson Managing Director and Senior Research Analyst. Michael, always a pleasure to grab some time with you. Thank you.
Sure, happy to do it.
Coming up, everyone, Tesla's chair selling $35 million worth of shares after the post-election bump. We'll bring you the details next. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, you've got STMicro, one of Europe's largest semiconductor firms, pushing back its long-term financial goals as it says lower demand for chips will extend into 2025. The CEO calling it a transition year. Now, there you're taking a look at some of the reaction that we're seeing here over the past 2 days, a net lower by about 0.9% here. But this is significant, no doubt, as it gives us a sense of what they are seeing, or at least those who are not Nvidia perhaps are seeing on the broader chip market and ultimately the demand profile of theirs versus some of the largest players.
All right, let's take a look at TJ Maxx. A lot of retailers reporting earnings out this morning. TJ Maxx parent company TJX, they were out with their results. The company raising its outlook on earnings and also pre-tax profit margin for the full year of 2025. For the quarter, the company noting that same-store sales did come in at the high end of its forecast. Yet you're looking at a drop of just about 2%. We're seeing some pressure across the board when it comes to consumer discretionary spend. We heard it from Target this morning, and TJX, the latest here, to show some pressure. Again, when you take a look at some of the numbers that they are reporting here within this, they are growing from a year ago. Net sales were up just about 6%. Comp sales were up 3% versus the 6% that we saw just about a year ago. So a bit of a slowdown there. One of the reasons that we're seeing a bit of pressure on shares this morning.
Absolutely. And finally, let's take a look at shares of TSLA, Tesla. The company's chair, Robin Denholm, sold $35 million of Tesla stock following the election. This is according to a regulatory filing. Denholm prearranged the sale of stock options earlier this year. Tesla stock is up over 50% in the past month. Now, typically when some of the sales like this are prearranged, largely, many times, it's due to tax reasons as well. And also if there are certain agreements that the holder of those shares has with the company as those tranches are dispersed, and then ultimately they're able to cash in after a certain amount of time so as not to send a shockwave through the broader market of holders of those shares as well here too. So it's part mitigation, both for their own taxes perhaps, but also so that there's not this massive aha moment in the broader markets or for the shares itself in TSLA when the rest of us investors catch wind that there's a massive share sale like this.
All right, keep it right here on Yahoo Finance. Let's do a quick check of the markets. Just about 26 minutes into the trading day. You're looking at some pressure across the board for the three major averages. You got the NASDAQ off about 0.6%. The S&P also below the flat line, also falling below that 5,900 level. The Dow now back in the red. Of course, the move to the downside coming with a heavy focus on Nvidia results. Those earnings will be out after the bell this afternoon. Keep right here, though. Coming up next on Yahoo Finance, my co-host tonight, Madison Mills, we will be having you for Catalyst. Much more analysis on the biggest movers driving today's action. We'll be right back. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills, 30 minutes into the U.S. trading day. Let's get to the 3 catalysts that we're watching this hour.
First up, Nvidia earnings after the bell. We'll bring you the details as options pricing in a $300 billion move.
Plus, Bitcoin powering on as the digital token hits a new all-time high. We will discuss with Mike Novogratz of Galaxy Digital.
And Bitcoin, not the only thing soaring. Elon Musk and Donald Trump watched the Starship launch together. We'll bring you the details and more on Catalysts. All eyes on Nvidia today with the chip maker set to report third quarter results after the bell. Joining us now, we've got Dan Morgan, Synovus Trust Senior Portfolio Manager. Dan, it's great to speak with you this morning. Good. We're very excited about these high expectations around Nvidia earnings today. It's the Wall Street party of the day here. What are you focusing on heading into those results?
Well, I think the world's going to come to an end at the end of the day if Nvidia doesn't beat the whisper number. I'm just kidding. But anyway, as we kind of get into this upcoming third quarter, we know that at the end of the second quarter, management guided for revenues of $32.5 billion, streets at $33 billion, but then the whisper number is always $1 to $2 billion higher than that. So that kind of puts us around the 34 to 35 billion rate. But I think the big number coming into this is going to be guidance going into the fourth quarter. The street's looking for around 37 billion. The whisper number is about 39. So again, the street is always adding another 2 billion to the consensus in regards to the third and fourth quarter. And if they don't beat that, we might see a sell-off like we did at the end of the second quarter when they beat consensus, but they didn't top the whisper number. So I think that's going to be the critical thing going into this report.
Would you buy on that weakness, Dan?
Yeah, the stock sold off in September, really after the last second quarter, went down in the 110 region, and then it's rallied back up, to 140 and kind of backed off a little bit. But, I would think the stock would be, very attractive for investors out there that have the risk tolerance or overall objective in regards to accumulating shares in that, 110, 115 range where it was testing back in September after the other sell-off we had at the end of the second quarter.
In terms of demand and what we're seeing from Nvidia customers, we know about 40% of their revenue comes from 4 hyperscalers. Do you need to see a broadening out of their customer base in this print, or is not all growth really going to be equal here?
Well, they have shown it, right? I mean, we know that 45% came from the hyperscalers, right, in data center. But we're also seeing an acceleration in demand coming from the sovereigns, right? They talked about on the conference call, Japan and all these other countries that are starting to really buy generative AI chips for their own use, at a country level. So I think that's a really good opportunity for them going forward. But, to be honest with you guys, we all know that the real growth in terms of generative AI has been in data center. The hyperscalers are projected to spend about $185 billion just to increase their overall capabilities, and a lion's share of that is going into AI. So even though there are other areas for them, it's still pretty centric on the data center.
Dan, what do you think the upside looks like for the AI trade, just in terms of how critical it is to the overall momentum of the market heading into 2025?
I think it's huge. I mean, Nvidia is one of the few companies that we can really show tangible evidence that AI is impacting their numbers. Advanced Micro Devices is another stock. Broadcom is another one. But then you start to look beyond that, and there really isn't a lot of tangible evidence. I mean, when Microsoft reports numbers, they'll come out and say, oh, Azure growth accelerated by 12 basis points directly related to generative AI. And we'll get the same kind of comments from GCP or AWS. Terms of Google and Amazon, but there's not a lot of real tangible evidence that we can see. So this is the poster child of AI. This is the #1 AI play in the semiconductor space. They need to execute extremely well on this third quarter to really validate that AI trade is still in place. If they were to have, for example, a big miss, that would be absolutely devastating to the entire AI trade that we've seen over the last 1.5 years.
especially given the wide margin that we are continuing to see of Nvidia versus some of those other semiconductor names in the broader semis ETFs. Dan, thank you so much for joining us ahead of those all-important earnings. Really appreciate it. Dan Morgan over at Synovus Trust as a senior portfolio manager. Well, Bitcoin's rally is back on as the digital asset reaches a new record high above $94,000 per token. Joining us now, we've got Mike Novogratz, Galaxy Digital CEO, and our very own Julie Hyman for the conversation. Julie, take it away.
Thank you, Maddie. Appreciate it. And Mike, it's good to see you here. Appreciate your time this morning. I want to talk a little bit about policy because part of the reason, of course, that we have seen this big increase in prices of Bitcoin has been the anticipation of a friendlier administration towards the crypto universe. And yet we've gotten a lot of appointments, but we've not yet learned who the head of the Securities and Exchange Commission might be. There were reports earlier in the week that the Coinbase CEO was meeting with President-elect Trump to discuss that very issue. Who would your dream pick be at the top of the SEC in terms of the crypto approach?
I mean, I like Brian Brooks just because I know him really well, and he was a great head of the OCC, and he knows our industry, dead in. But anyone Donald Trump picks, given the overall pro-crypto attitude of this administration, is going to be fine. If you think about it, right, Vance, Vivek, Elon, Kennedy said he's got his whole net worth in crypto. Howard Lutnick, who just became Commerce, is a big advocate of crypto. So all the guys around the table, Donald Trump himself has got his own coin and was an NFT issuer. All the guys around the table like our space. They believe in the digital asset world. They believe in blockchains and Bitcoin. And so the whole energy of this administration is going to be so different than the Elizabeth Warren, Gary Gensler era.
Well, and Mike, that word energy, I think, is a really important one because as we know in the crypto space, vibes are very, very important. But I guess my question would be are they more important than policy? Like what specific policies would you be looking for?
The most important policy is a direction from the president through the Secretary of Treasury, through the OCC, the SEC, the FDIC, to allow U.S. players to participate, right? There was a thing called Operation Choke Point, which broadly made it miserable for U.S. players to participate in this industry, right? Fear of litigation, you couldn't get banked. Our audit at Galaxy cost 3 times what it would if we were a non-crypto company. So we're spending $9 million a year on an audit for a medium-sized company. That's insane, right? So the tax on crypto has been brutal. That is going to come way down. People aren't going to fear, they're constantly getting a Wells notice.
And I'm also curious what all of this is going to do for Bitcoin itself versus altcoins, or do you think it's sort of rising tide lifts all crypto boats?
Listen, that's always been the case. Right now, there's a distinct Bitcoin story as these big convert issuers they're buying Bitcoin. You got a lot of overseas buyers buying Bitcoin. And so I think broadly, it's starting as a Bitcoin story. But Bitcoin's always been the gateway drug for the digital asset space. And with better regulation around market structure, around what's a security and what's a commodity, right? What's a utility token? Once we get more clarity around that, you're going to see a lot more development and innovation. So one of the reasons you haven't seen the great innovation in this space is people were scared of it, right? The big players were. And I think that's all going to change.
One thing that could certainly change that is a Bitcoin strategic reserve. There's been a lot of excitement about the government potentially buying up to 1 million Bitcoin. Do you buy that that's going to happen under this administration?
Don't know. My gut feeling is it will be really good if they do this. If they just pledge, which Donald Trump did in Nashville, not to sell the $20-odd billion of Bitcoin they have, that's a big win. I do think buying some Bitcoin to send a message that we're going to lead the world in Bitcoin is a smart idea. Yeah. I don't think the US dollar needs anything to back it up. We've got the strongest military in the world. And so, again, my guess is buying 1 million Bitcoin would seem a little extreme to try to back, a $28 trillion economy up. But sending the message that we're going to lead in this space, I think is a great idea.
I also want to get more of your take on some of these personnel decisions, obviously with Lutnick snatched up for Commerce. In the press release, they talked about how he's going to be a leading voice on tariffs with direct responsibility over USTR. He said that there will also be no carve-outs for the likes of Apple. He speaks fondly of an era with low income taxes, high tariffs. How are you positioning around a potential impact of tariffs given the likes of some of these personnel we've already seen get picked for these positions?
You know, a lot of, you had a big move already in dollar China, dollar Mexico. And so we'll see. You know, Donald Trump is great at scaring people. And a lot of this tariff bluster is to get the other side to the table and negotiate better trade deals. And so I think we'll see how it plays out. You know, blanket giant tariffs bad for the economy will slow the economy immensely, and bad for those countries. But I don't think that's where we're going to end up. I think we're going to start that, and we're going to get better trade deals between us and China, and us in Latin America, and us in the Mideast. I'm sorry, us in Europe.
And Mike, getting back to Bitcoin itself here, we just had the introduction of options on IBIT in particular. Deal. Yes. So talk us through that. Why is it a big deal? What are the implications?
Listen, the one thing that is clear in these markets, and you can see it with stocks like MicroStrategy or Nvidia, is that there's tremendous amount of option playing from retail punters, and they love short-dated options, 1 week options, 1 day options, 1 month options. And up until now, in the Bitcoin ETF, there was no way that a Robinhood investor could play an option on IBIT or any of the other Bitcoin ETFs. And so that's going to change. It was off to a huge day yesterday, and I think you're going to see that just grow.
Does that increase or decrease volatility, Mike?
It will increase volatility, 100%.
And so, which is interesting to me because it's already a volatile asset.
You know what? I think I've said this over and over. It's strange to me that people feel a need for monster leverage on an asset that trades, at 50 or 60 vol itself. I think that's why lots of people get burned. You're up, you're up, you're up. Ooh, you're down. And in manias, people love leverage. There's a lot of leverage in the system right now. At one point, there'll be a washout. I don't see it. It maybe doesn't happen until next year. But by definition, when there's tremendous one-way direction, something happens and everyone runs the other direction. And that's the nature of the beast in crypto at this point. I do think over time, years, not weeks and months, the volatility will come down. When we talked about this in 2017, Bitcoin was a 100 vol asset, and now it's a 50 vol asset. And so over time it matures, but right now it's a hot potato.
Yeah, still more volatile than everything else, but less volatile than it used to be.
Yes.
So how high do you think the potential is for the price to go before that washout? And then what are the sort of contenders to then trigger that washout?
Markets love big numbers. Markets love big numbers, and so 100 seems like it's a good place for it to start. 100K, and we're at 94 now, so that's 6.5% away. I do think there's a chance that it could really accelerate up if we start seeing the big sovereign wealth funds buy. And we're seeing a little bit of that out of the Mideast.
How will we know when they're buying, Mike?
It after they buy something, it usually gets announced or it leaks through the rumor mill, and people see flows, and some people will talk about it, other people won't. But what's been interesting recently is there is someone selling a lot of Bitcoin at 92, 93, 94,000 because there have been massive buying, right? Our desk has only seen buying, not selling. And most of my friends who are in the hedge fund business, our client base, are buyers, not sellers. But someone's out there selling a lot, and that's what makes a two-way market. One thing to understand, this is the first global asset we've ever dealt with. When I say that, there are individual people in every country of the world that participate in Bitcoin. And you can't say that about another asset in the world, other than maybe the dollar. And so, it could be Chinese miners for all I know. We're not seeing the flow, but there is somebody selling a lot of Bitcoin into all this buying.
Mike, I just want to get your take on the kind of relationship between Bitcoin and the dollar. Then I've heard you talk about the increased global demand for Bitcoin alongside global fiscal expansion. What does that mean for your outlook on the dollar? Could we see demand for Bitcoin turn into a headwind for treasuries for the US dollar?
Listen, we're still a small market. It's, we're even at 100,000, right? You're $2 trillion, right? What's gold? 15 trillion. So we're a seventh of gold, right? It's a long way before we're starting to be a headwind for the dollar. Like, we're more a report card. We're a report card on how global fiscal stewardship is doing. And listen, there's one side of me that thinks if you get Kevin Warsh and Scott Bessent or any of the guys, the guy from Apollo they're talking about now around the table, and these guys have their way, they're some of the smartest guys on economic policy America could hope for. And I would bet you they'd fight pretty hard to bring down the debt to GDP ratio. And that wouldn't be good, right, for Bitcoin if they actually accomplished it. Unfortunately for them, it's really tough, right? You're going to have to cut Medicare. You're going to have to cut Social Security. Those are political issues. That's Congress, not necessarily the executive side. And so I think even with the best guys trying, you're still going to have a big deficit next year. But that's a risk to, the thesis of easy money forever, right? If you get guys that say no more easy money, I mean, look what they did in Argentina. Inflation comes down. I mean, first, you put your economy into a stall, inflation comes down, efficiency goes up, and you'll see all Argentinian assets rally. Like, Argentina is an amazing place to invest right now because they've had these reforms. And so, like, that would be the counter argument. I just think adoption and the rest of the world being fiscally profligate is going to drive Bitcoin first.
Mike, finally, I want to ask you about mining because you guys have some Bitcoin mining operations, but as of late, you diverted that to a deal with hyperscalers, right? With AI hyperscalers. Why did you guys do that? And does price action change that calculus at all? Or is that kind of the decision's going to stay that way? Listen,
the AI demand for energy is so great if you have energy in 25, 26, 27, and the price, it makes it a better investment than Bitcoin, certainly over a 3, 4, 5 year horizon. Listen, as price goes up, Bitcoin mining becomes a better business. It's been a very difficult business because so many people have thought they can make money in Bitcoin mining that the hash rate just keeps going higher and higher, right? We might see that change as some people unplug their Bitcoin mines and put in AI data centers. But right now, for us at least, the data center play looks a lot more profitable.
All right, Mike Novogratz of Galaxy Digital, thank you so much for joining us, and a huge thanks to our own Julie Hyman for bringing us the conversation. Sean, I'm going to kick it over to you for a check on the broader market.
All right, Maddie, just about 50 minutes into the trading day, let's take a look at where we stand. This market check sponsored by Tasty Trade. You're looking at the three major averages right around the lows of the session. You have the NASDAQ now off about 1.2%. The S&P also under a bit of pressure here, as well as the Dow. Flipping it over to the bond market, bit of a relief here that you could see, at least initially, although some of the reversing of that actually. You're actually looking at yields pushing to the upside here. Right now, you have moving up by just about 3 basis points to 441 on the 10-year. Keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back. You're watching Catalysts. UBS echoing Goldman's bullish call on gold, predicting the bullion could rally to 2,900 an ounce by the end of next year. Analysts are predicting more buying from central banks, and elevated global uncertainty is going to continue to drive that rally into next year. They've called that. Now, earlier this week, Goldman Sachs forecasting that the precious metal would climb to 3,000 by the end of 2025. Maddie, we just had a guest on last hour talking about the fact that he was still bullish on gold, Nate Tufton. He was saying that he actually sees 3,000 very much within the realm of possibility. So we have seen a bit of a flight to safety. We have seen gold take off. I think the big question is what exactly is going to be that catalyst to get us potentially to that 3,000 level.
And that's exactly what the UBS analysts note, this idea that there could be some consolidation in a short term, but long term, they are expecting gold to hit $2,950 an ounce by the end of 2026. And it's interesting, I thought, the kind of concerns that they point to short term. They talk about the red sweep supporting a lift in prices more long term, but they also talk about U.S. fiscal stimulus leading to higher for longer global uncertainty. And we certainly saw that yesterday on the back of that geopolitical news that saw a bit of a bid in gold and also in treasuries. So it was interesting to see that kind of safe haven trade happening yesterday here. All right, we're going to get a look at the overall market and expectations. Joining us now on set, we've got Brian Levitt. He is the global market strategist over at Invesco. And Brian, it's great to have you in studio with us. Thank you so much for coming in. I do want to start a little bit more broad, and then of course we'll get to Nvidia. But we saw that huge post-election rally in the market, and then it's coming in a little bit. How are you thinking about where we kind of land after all of that volatility?
Yeah, we saw that in 2016 when Trump won as well. You had a pretty big move in cyclical stocks early on, smaller capitalization, and it didn't sustain. And so the challenge is the hope of Trump is higher nominal growth because you're going to get tax cuts and deregulation. But then on the other side of that, it's a little bit of a Rorschach test because you've got uncertainty around trade and industrial policy and fiscal consolidation. Those things tend to be more of a headwind to growth. So what do you do about it? I mean, I'm not going to interpret a Rorschach test. I interpret what I always interpret, and that's leading indicators of the economy, which are generally stable, but not really pointing to above trend growth. And the Fed's kind of scaled back their expectations for rate cuts. So to me, that's not consistent with a higher nominal growth environment. It's fine for markets. Right? It should be fine. But to me, that still favors more higher capitalization, quality, rather than the so-called Trump trade.
So talk to me a little bit more about it being fine for markets. I guess, what does that then look like?
No, it's a good backdrop for markets. I mean, people are focusing on, well, will there be volatility? We've had such a nice move. Yeah, if you get policy uncertainty, like we had in 2018, uncertainty around the trade war, we did have to take a leg down. But the backdrop for markets still looks quite good. I mean, we're beyond inflation. We're beyond tightening. I think over time, the 10-year rate will come in a bit. So all of that is a good backdrop, decent enough nominal growth to support corporate earnings. So I think stocks go higher. I think we have the so-called Santa Claus rally. I think stocks go higher in 2025. But you do have a little bit of policy uncertainty that could, in the short term, create the market volatility that investors have been, maybe waiting for. I think they're always waiting for it, actually.
Yeah. Well, you said something really important there, which is that, we're beyond inflation. And I wonder if we can stick on that idea.
Yeah.
Are we definitely beyond it, especially given incoming tariffs?
Yeah, so we are certainly beyond it right now. Now, people will throw things at me when I say that because they're talking about the high cost of living. I'm talking about what the Fed's focusing on, which is the rate of change in inflation, which is back in the comfort zone. Interesting thing about tariffs, we know that tariffs can create less optimal economic outcomes. Currencies tend to adjust, so it probably does mean a bit of a stronger dollar. And I would view where the consumer is right now as tariffs perhaps being a little bit more of a tax on the consumer rather than the beginning of a next stage of inflation. The reason we got inflation is because we responded with force to a pandemic. Everyone had money in their pockets, but the supply chains weren't open yet. That was why we got inflation. I don't think we're going back to that environment. And given where the consumer is now, I think the tariffs are going to be a little bit more of a tax than than the beginning of the next stage of inflation.
Yeah, that's interesting. And I also think it's a different perspective because we've heard very much maybe more of the concern about ultimately what that's going to do to complicate the Fed's fight to tame inflation. Brad, how closely, or I guess how much does it matter in terms of the pace of those rate cuts, right? There's lots of debate about whether or not we're going to get an additional 25% or 25 basis point cut, next month. And then looking ahead to 2025, what's baked into your forecast at this point?
I think what matters with the rate cuts is market leadership more than whether the markets can continue to do well. Because every time the market gets the sense that rates have to come down rapidly, you get a nice small cap rally, right? You get economically sensitive parts of the market doing really well. And then when you price that out, you tend to get a shift more to higher quality and those types of businesses that don't necessarily need the rate cuts. Ultimately, I think we've got to at least get to neutral. Now, people will quibble what that is. You want to call it 3.5, you want to call it 3, whatever. We got to get to neutral. The larger question is, do we ever need to get to accommodative? And the market, not that long ago, was thinking we needed to get below 3. I would categorize that as accommodative. Now the market's in the more mid-3s, so I would consider that more neutral. But the Fed's going to go at a slow pace. I don't think market leadership's going to change all that much. It's still going to be quality cash flow generating businesses.
It brings me to a point that I've heard you bring up before, Brian, this idea that you only have to really question it if it's going to impact growth or impact the movement of the Fed.
Yeah.
Where does Nvidia fall into that? Does Nvidia really have the chokehold over the market that we all say that it does, given that the Fed isn't really going to care what happens tonight?
Yeah, Nvidia is has a large position in the S&P 500, so it can move the markets one way or the other based on whether it disappoints or surprises to the upside. But I would view that as a couple a day thing in the market. I wouldn't view that as what that means for Nvidia or the S&P 500 over the intermediate term. You have to remember, these are businesses that are investing heavily in what they believe and what we all believe is a structural trend. So quarter to quarter, depending on the timing of it, you could see the investment show up but not the delivery show up, and vice versa. So you may get whipsawed a bit, but the demand for Nvidia chips going forward is likely to continue to be strong over the intermediate term until, the moat around their business or other competitors start to emerge. So that's a very good intermediate story. If I'm an investor, I am an investor, don't allow yourself to get too concerned about the move one way or the other the day after Nvidia reports.
Brian, what's your read just more broadly about the AI trade and AI momentum going into 2025?
AI trade is largely rewarded those who are going to bring us AI. It's largely rewarded, the chip manufacturers, software providers. I don't even believe this market has begun to consider the productivity gains, the efficiency gains downstream. I'm even using it already. I'm probably using it to the extent that I'm going to take myself out of a job, but I am, it's recording podcasts for me, it's editing my commentary. So this is going to be a long structural trend. There will be winners downstream. I think the market is not even considering. For the largest names, again, I think intermediately, they're well positioned. Over the intermediate term, they're well positioned. There's going to be quarters where investments and deliveries may misalign, but this is a long-term story, and many of those companies have nice moats around their businesses.
All right, sounds like ignore the noise heading into tomorrow at least. Brian, thank you so much for joining us in studio too. We really appreciate it. Brian Levitt over at Invesco. Coming up, we're taking a look at some trending tickers on Yahoo Finance. We'll give you the news behind those moves next, right here on Catalysts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. It's all done with Yahoo Finance's trending tickers page. First up, let's take a look at Super Microcomputer, the stock giving back some of its gains that we saw yesterday, off just about 6.5% in early trading action. Now this comes as options activity implies more volatility is on the horizon for stock. I don't think that necessarily comes as a surprise here to many, given the magnitude of the concern and also the move that we saw in the stock yesterday. But the moves coming and this call coming after the company was able to hire a new auditor and submit a plan to become compliant with the Nasdaq's listing requirements. We saw the stock surge in yesterday's trading action, surging just about 30% today, giving back some of those gains, although you can see in a longer term chart right now on your screen, and even going back a little bit longer, if we can do a year to date, I think that shows the peak that we saw back in March compared to the levels that we are currently seeing. Clearly just a fraction as to where we were trading here. But again, we are still above 26 bucks a share. I think this does remove maybe a little bit of an element of uncertainty there, but there are still certainly lots of questions just about Supermicro's business, the insides of it, what exactly is being reported, what is not, and what ultimately that growth and trajectory looks like here, Maddie, in the coming quarters.
I think it's a temporary Band-Aid, right? And it's great that you pulled up that year-to-date or over-year chart so that we could see how much they've come off of their highs. It's interesting taking a look at Wall Street's reaction, too. We've got 58% of the street having a hold rating on the stock, only 25% of the street with a buy rating. Also, a lot of suspensions of coverage over at Mizuho, Rosenblatt, no longer having a rating on the stock. So I think there's a lot of wait and see in terms of Wall Street here, because there was a really positive lift in SMCI for a while. It was the best performing stock year to date, even outpacing Nvidia. This is the company that supplies the servers that chip firms like Nvidia do rely on. Really important, especially when you think about Nvidia asking for those server suppliers to help them with Blackwell overheating. And this was a pick and shovel name for a lot of investors looking to play AI on a second tier investment cycle. So it'll be interesting to see kind of whether or not they're able to meet the accounting requirements that the street is looking for to gain a little bit more momentum moving forward here. Next up, Qualcomm forecasting its foray into non-smartphone products will generate an additional $22 billion in annual revenue by 2029. The outlook announced at its Investor Day comes as the company is looking to expand beyond its current stronghold in the smartphone space.
Well, Market Domination host Julie Hyman, she was able to catch up after Qualcomm's Investor Day yesterday and spoke to the CEO about what the incoming Trump administration and potential tariffs could ultimately mean for the company.
I think based on what we do, based on the importance of semiconductors in general for when you think about economic security, we work well with every administration. And I think we work incredibly well with the first Trump administration if you look back. At the end of the day, we're always going to have a dialogue of what's important for trade, for commerce.
All right, so looking past some of those potential headwinds here, at least in the immediate term, when it comes to what we heard yesterday in the street's reaction, I think lots of positivity just in terms of what they're doing to further diversify their business, not so reliant on smartphones. That's been one of the concerns there for Qualcomm. And I was going through some of the quick reaction here this morning, and JP Morgan was out saying that they are doing well just in terms of diversifying that business. They are cheering that move. They still, though, see the outlook, and I don't think this is necessarily a surprise given what we know about Qualcomm's business, but they do see the outlook for the smartphone revenue in the intermediate term as going to be critical here just in terms of driving the stock price and ultimately what we see in terms of that action here, at least in the short term again. But when you take that longer term view and Qualcomm's longer term growth, the fact that they are diversifying further away or I guess just a larger pool in terms of their revenue base, I think that's largely being cheered here from the street.
Absolutely, because they've been warning that Apple is not going to be the lift to the company that it was previously, and they've been issuing that warning because they didn't want investors to short the stock once that became an issue. They did talk about the rise in other revenue streams at that Investor Day, not only talking about growth from PC chips, but also talking about the automotive revenues rising. I think that's going to be really interesting to monitor, given what we know about potential full self-driving technology moving forward. Could Qualcomm be a beneficiary of that moving forward here? And they say that they could see a rise of about 175% by 2029 to $8 billion for that automotive revenue. So that would be a huge catalyst for the stock. Well, finally, Pivotal Research lifting its price target on Netflix today. We've got a street high here of $1,100. In a note, analysts say they see opportunity for subscriber growth from Netflix's foray into live sports, with last week's Mike Tyson and Jake Paul fight being a positive catalyst for the stock. Analysts view the event as a, quote, very successful learning experience, expecting Netflix will accelerate its offerings of eventized live programming in the future. I think it's really interesting they are that positive on that event because of the kind of consumer demand for it, given the streaming and technical challenges.
Yeah, and I think ultimately what this means and why they were so bullish on that line is what exactly that means in terms of the subscriber churn, right? They see those types of events and the stickiness there really working with their subscribers, and they ultimately think it's going to lead to less churn, which is obviously a huge positive here for Netflix, and a greater ability to take price. And I think that is the critical differentiating factor when you compare Netflix to some of the other streamers within the space and their dominant position within that, the willingness to spend up for Netflix, and also just how successful their ad tier has been. I think analysts were very bullish on the ad tier going into the launch, but I think the numbers that we have seen largely have exceeded expectations, and how much it is the ability here to add to that revenue growth going forward. It's hard to find a bullish analyst out on the street that doesn't mention that line, just in terms of how integral that is and important it is to the company's bottom line here going forward. But again, as you look at some of the growth opportunities within the event space, and you look at the success overall, I think it was a very successful fight over the weekend. Obviously, a high visibility event. They will be pushing further into live sporting events this holiday season with the games on Christmas Day when it comes to the NFL. So again, a greater opportunity there in order to really showcase their talents and abilities, and just, I think, further prove their dominant position within that space.
Yeah, hopefully the streaming capabilities will improve for those Christmas Day games. All right, well, coming up, we're going to discuss what a Trump presidency could mean for the future of private equity. We've got Thomas H. Lee Partners co-CEO Scott Sperling next, right here on Catalyst. Stick around.
Christmas is back on at Apollo. So I think you will see for us small additions to our capability through acquisitions, but I will be surprised if something transformational happens. We have so much to do in just our base business that it's some new toys now.
That was Mark Rowan, the CEO of Apollo Global Management, and reportedly one of Trump's top contenders for Treasury Secretary, speaking last week at Yahoo Finance's Invest conference about the appetite for acquisitions under the incoming Trump administration. We do want to note that Apollo is the parent company of Yahoo, but the promise here of tax cuts and deregulation under Trump presidency, it could potentially open the door for more deal-making activity in the years ahead. Let's talk about that and more. We want to bring in Scott Sperling. He's a co-CEO of THL Partners. Scott, it's great to see you here, and thanks so much for making the time to join us here at Yahoo Finance. I'm curious, with the incoming Trump administration, how is that factoring into your strategy looking ahead to 2025?
I think one of the things that we're expecting with the new administration is a significant bump in the potential for growth in the overall economy and a reduction in the cost of doing business through a number of the things that you just mentioned. So I think probably most powerfully, it has been a very onerous regulatory regime over the last 4 years. It's not just the antitrust, although that has been an area where the administration has created all sorts of new theories that the courts have almost always overturned, but it raises the bar significantly in terms of the cost of M&A. But there are many, many areas where just the overall cost of doing business in the country has risen significantly because of the regulatory environment. The various threats up from a tax perspective have also created uncertainty. Now, all of this has been exacerbated by recent moves to try to take some of our leading technology champions and put them under significant pressure, again, from an antitrust perspective, but also in other regulatory areas, all putting a little bit of a pall over the area that the markets find to be most interesting from a growth perspective, which would be some of these large technology plays that require enormous tens of billions, hundreds of billions, trillions of dollars investment in cutting edge new technologies that will make everything work better, will reduce the cost of almost everything to consumers, and yet require that enormous investment, generative AI being the most prominent example of that. So I think for all of those reasons, the opportunity set for all business, I think, is probably greater with the new administration, given the issues that we've seen in the last 4 years. I think for private equity specifically, we will benefit as everyone else will in the business world from this change. And I think the flow through, again, to being able to provide anti-inflationary forces to deal with some of the incredible inflationary pressures that we've seen of the last 3 years in particular will be very welcome for consumers.
I imagine that some of the final personnel picks from the incoming administration will clarify the path forward for some of those inflationary policies that you mentioned. Given that we still don't have the Treasury Secretary, I just want to get your take. Do you like Mark Rowan as the Treasury Secretary pick?
I'm sorry, he is, you're telling me, or would he be a good one?
Do you like him as a potential? We don't have the pick just yet.
Mark's a friend, and I do like him, and he's a really smart guy. He would be an excellent pick.
Is he your top pick?
I don't know all the other candidates, but he would certainly be, for me personally, right at the very top of the list.
I think that makes a lot of sense, just given your background. Scott, let's talk a little bit about just the economic backdrop a little bit more broadly. You talk about the fact that you're bullish right now just in terms of the expectations of a Trump administration, what that's going to do in terms of deregulation, what that will do in terms of investment opportunities, deal-making opportunities looking ahead. I'm curious to get your insight just on Fed policy and how you see that playing out here over the next several months.
So the Fed has obviously a very difficult problem, and that is that we've been through a decade or almost a decade and a half of incredibly stimulative monetary policy. That coming out of the great financial recession was very important during the course of the pandemic was important, but I think many would argue probably was too loose for too long. And the crisis with inflation was created by having that very expansive monetary policy combined with fiscal policy that went beyond what was necessary to help the average person post-pandemic. And, there were a lot of people, Larry Summers among them, who were predicting high rates of inflation coming out of some of the excess spending that the government decided to embark on in the late 21 through 23 time period. And we're still dealing with a lot of those problems. We are obviously running deficits that, in the normal course of our history would have thought to have been unimaginable. And we seem to do that now as a matter of normal course. That adds to a overall debt level that is 3 times what it was only less than 15 years ago. And so interest is now eating away at the rest of the federal budget and taking away degrees of freedom. And the Fed has to look at all of these things, respond to an economy that and a market that is looking for some Fed rate cuts. But what we've seen is the Fed rate cuts have reduced some of the near-term rates, the shorter rates, but the longer rates actually went up. And I think that's partly in response to the fact that the amount of refinancing that the Fed needs to do has increased dramatically. So you have a supply and demand issue for, certain 10-year and above, at least, treasuries. And that problem, as we continue to run $1 trillion north deficits, just gets worse. So the Fed is in a challenging spot, in my view, where they're trying to, again, manage an economy to avoid recession, to keep employment at as high a level as possible, but at the same time have this incredibly difficult problem on the monetary and budget side.
Scott, just sticking to that first part there, when you talk about the rising risk of a recession and following Powell's comments that we just got last week, that he's in no rush to cut, I guess, how are you looking at the possibility here of a rising risk that the Fed is once again just too slow to act this time to the downside?
So, again, there's a tale of two cities here, as they say. A lot of friends who are in the industrial world will tell me they're not afraid of recession happening. It's happened, that their industries have been in somewhat of a recessionary mode for actually quite a while. And then obviously, if you look at the Magnificent Seven, which has accounted for almost all of the extraordinary growth that we've seen in the public markets, and other areas of technology that have much more attractive business model characteristics as well as growth characteristics, they've obviously done extraordinarily well and have done well for good fundamental reasons. You're also dealing with a bifurcation that we haven't seen in a very long time in our economy. And so you're trying at the same time to manage against a potential for a reignition of inflation at the same time that you're also dealing with many parts of our economy that already are seeing and have seen some recessionary signs.
All right, Scott Sperling, we got to leave it there. Thank you so much for joining us this morning. Scott is the co-CEO of THL Partners. Thank you, Scott.
Thanks so much.
Coming up, President Donald Trump joined Elon Musk for the latest SpaceX launch. We're going to bring you the details of that next. SpaceX completed its 6th test flight of its gargantuan Starship rocket, which successfully took off in Brownsville, Texas. Minutes into the flight, SpaceX scrapped plans to attempt to catch the booster with giant mechanical arms referred to as chopsticks, which the company had completed during a previous flight. The booster, dubbed Super Heavy, was still able to perform a controlled landing in the Gulf of Mexico. SpaceX CEO Elon Musk was joined by President-elect Donald Trump. Trump and Musk continue their relationship as Musk prepares to head the Department of Government Efficiency as a part of Trump's incoming administration. Earlier this week, we spoke with Andrew Shannon, Procurum's co-founder and CEO, about the importance of SpaceX.
SpaceX is an incredibly important company for not just the U.S. space economy, but for the global space economy, and what they've been able to do to dramatically lower the cost of accessing space over the last decade has been nothing short of incredible. And to the extent that the company is able to continue to deliver on its various goals, as well as being able to lower the cost of accessing space, that could have tremendous knock-on effects for not just SpaceX, but for other companies in this area.
And Sean, it was interesting talking with him just about how he actually feels like even competition from other countries and other nations around the world would also be a boon for SpaceX, just given that any interest in money flowing into the space is a good thing right now.
Yeah, and it almost seems like Musk and Trump just can't get enough of each other these days. They're almost together, it seems like, on a daily basis. But I think my takeaway from this, and my takeaway really from the last several weeks and how everything has played out, is just the outsized influence Musk is expected to have in the Trump administration when it comes to regulations, when it comes to processes, when it comes to priorities here over the next 4 years, and exactly how that plays into the hands of Elon Musk's businesses, specifically SpaceX, and some of his ambitions here going forward. I think that is a critical question and a critical thing that investors need to keep in mind as we talk about the direction here, not only NASA's exploration goals, but exactly SpaceX and what that ultimately means here just in terms of their growing, growing obviously very quickly a size market player within that space. All right, keep it right here on Yahoo Finance. Coming up next, it's Wealth. It's dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Hey, our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. We've got a very special bi-coastal show today. Yahoo Finance's Rochelle Akufo and host of the Decoding Retirement podcast, Bob Powell, are out in San Francisco, the Paris of the West, spearheading coverage from the Schwab Impact 2024, an industry event where thousands of registered investment advisors, those RIAs, gather every year to share ideas, build knowledge, and find some new inspiration to improve their clients' lives and businesses. So, on today's cross-country show, let's dive in. One, we're going to speak with one chief investment officer about Nvidia's big earnings report after the bell. We're also going to talk about the AI trade and how you could play it. Plus, our tech editor, Dan Howley, will explain how you might be using Nvidia's GPUs in your everyday life. And we'll tackle animal spirits. You heard that right. Animal spirits are how human emotion can drive investment prices. We'll dig into all that. And if that's not enough, guess what? 2025-2026 FAFSA form. It's now open to everyone during a beta testing period. You can submit the form today. We'll detail everything that you need to know to get it done. But first, let's get a quick check of the markets here. We're 90 minutes into the trading day. As of right now, you're seeing a little bit of a pullback for the Dow, the S&P 500, and the NASDAQ. Declines across the board, flat as they may be for the Dow, down about 0.06% there. S&P 500 lower by about 0.5%, and the NASDAQ composite, that's down by about 0.6%. All of this ahead of a huge earnings report. Nvidia, of course, one of the bellwethers of the earnings season. Many might say the bellwether of the earnings season. You're seeing shares there lower by 0.6% coming into that report coming Wednesday after the close. And let's also check in on Bitcoin. Right now, BTC USD is higher. Right now, just shy of $95,000. We're seeing gains today over this 24-hour period of about 2.5%. All right, let's also check in with Rochelle and Bob over at Schwab Impact. Rochelle, Bob, I mean, this is a gathering of investment advisors here. I want to know what's top of mind at this conference for both of you.
You want to swap your phone? Well, there's a couple of things that we're keeping an eye on, Brad. So first of all, what I'm looking at is some of the strategies to manage people's financial concerns going into 2025. A lot of uncertainties that we know of. And of course, economy and the inflation still top of mind for people, yet consumers still spending, perhaps not managing their investments as they should, perhaps a little bit of fear in there as well. We're going to be talking about that. Another thing I'm looking at is succession planning. We're going to be seeing the great wealth transfer beginning from boomers to their heirs. An estimated 53 trillion is expected to be transferred between now and 2045, according to Cerulean Associates. So how are they managing those investments? What does that mean for risk appetite? And what does that mean for the heirs who are having to take this on? Another thing I'm looking at as well is going to be AI. We know we've been hearing it in every other, sort of sense of the word in investment. But specifically, what does this mean in terms of that balance between having human interaction with financial advisors, perhaps better estimations on investments that people might want to make? So really taking a look at some of those balances. And Bob, what are some of the things you're looking at?
So I'm focused on retirement, as you know, Rochelle, and I think I'll be looking at how will the fear play out for retirees? Will they need to adjust their portfolios? Will they need to reduce the amount they have in fixed income or reduce the amount they have in equities? And then we had a session yesterday where folks were challenged to learn more about Medicare because the costly mistakes that could be made are sort of eye-opening in terms of what damage could be done if you make the wrong decisions.
So certainly a lot to watch. So more sessions today and tomorrow. We'll have lots of great interviews coming up. Back to you guys.
All right, Rochelle and Bob, looking forward to it here. Much more to come from the Schwab Impact 2024 in this hour. Here's a look of that interview lineup. In just a few minutes, you're going to hear from Kathy Jones, Schwab's chief fixed income strategist. And then a little later on in the hour, Rochelle and Bob will speak with Omar Aguilar, good friend of the show, Schwab Asset Management CEO and CIO, plus Gabelli Funds co-CIO, Chris Marangi. Now, one of the biggest market movers of the day, Nvidia, set to report after the closing bell today. My next guest says that the results will be a lens into the health of the AI economy, the landscape, the industry. Here with me now, live in living color, we've got Andrew Cray, who is the Crescent Grove Advisors Co-Chief Investment Officer. Great to have you here in studio.
Great to be here.
Absolutely. Do you see megacap tech continuing to meet high expectations, and is Nvidia the ultimate test of that?
I think it's clearly the lens, as you said, into the health of the AI trend, and I think the bar has been set incredibly high. And you see sell side consensus, and then you hear whisper numbers that are way beyond where sell side consensus is. You look out forecasts for 2025, 2026. And what I think people are going to be looking for today is kind of what the trajectory is in the future as well for Nvidia's top line growth. Can it support the valuation that's being assigned to it by investors and kind of, I guess, rationalize the enthusiasm that's been it's just underpinning this theme? And if you look, yesterday alone, Nvidia was responsible for a huge majority of the gains of the S&P 500. So it's clearly an underpinning of what we've seen this year and even going back now 18, 24 months of market performance. So it's going to be critical, I think, to understand what that path forward looks like.
How do you expect the market to perform when these companies are in that process of growing into the valuations that they've already front run?
Well, I think you go back to animal spirits, you referenced in the opening, right? It's just this idea that people get so enthusiastic about the trajectory of these new technologies, and go back to the dot-com bubble sort of as the canonical example of just the amount of enthusiasm, how far valuations can get stretched around some sort of theme like this. From our perspective, we think maybe we've gone a little bit too far, and we're at least at risk, I think, of seeing some sort of reset from a valuation perspective, just because the bar's been set so high. So are there other opportunities then from a relative value perspective to look at sectors perhaps more on the value side of the equation as opposed to the growth side of the equation that have interesting opportunities going forward that may be less demanding from a valuation perspective?
What are those sectors on the value side of the equation you like right now?
Sure. So I'd say one that we would point to would be financials. If you look at that as sort of a function of the Trump trade, if you will, I think lower corporate tax rates potentially on the horizon. You look at sort of a deregulation type of agenda. Financials become an interesting place to look at. They've already seen a little bit of an uptick in a response to what we saw from the red wave of the election. But just broadly speaking, I think if you look at the value index relative to the growth index, the valuation picture is just much more favorable. And if we see a pro-growth agenda, if we see more of a pro-cyclical kind of economy where it's almost more of a no-landing type scenario as we go into 2025, that's going to be supportive for those types of sectors.
When I hear no landing, it almost feels like the market is trying to just put the Fed on the back burner, almost even mute the Fed or any noise coming from the Fed, because the policy pathway right now would support that too. And so if that is the case indeed, it seems like there's going to be more focus on what policy comes forward next year. Is there policy that you see rattling the markets or adding an additional catalyst into the markets?
Well, I think the trade and tariff policy, until we get some clarity around what that looks like, will be a little bit of an overhang, and in particular if you look at non-US stocks, right? You look at China probably being the key example of an economy and a market that's going to have this sort of rhetorical overhang, just sort of a difficult landscape to navigate if you're investing outside of the US, let's say. But if you go back and you talk about the Fed, and think about what sort of market participants are expecting. They celebrated the fact that the Fed was leaning in a more dovish direction. Right. They came out of the gates with a 50 basis point cut, right? But then there's sort of been the shallowing of the trajectory of future rate cuts as the Fed has said, you know what, maybe we can go a little bit slower. We're in no hurry. The economy's been more resilient than we thought. So there is probably going to be a little bit of a tension there where if the Fed says, we're just going to step back now and kind of see how things play out, and we also see more sort of pro-cyclical, pro-growth type policies being pursued that might expand the deficit, might be supportive for growth, which is a good thing, all things equal for equities. But on the bond market side of things, yields might tick up, right? How do those things interplay, and how do equity investors look at that? When do they get spooked? Is it the 10-year at 5%, 5.5%? That's, I think, going to be kind of the core tension that we're looking at in 2025.
There's been a lot of chatter and discussion and evaluation around the mentality of buying the dips right now. And as you think about the broader kind of risk-on sentiment that we've seen post-election, and really now looking perhaps to Bitcoin as one of our proxies for risk-on, indeed. And as you think about that, where do you think there is the opportunity to buy the dip versus where investors would be savvy to perhaps sit out of certain dips?
Sure. Understood. I think for us, we go back to this idea of tech and what's really been driving markets over the last 18 to 24 months, the mega cap tech names. I think it comes back to basic portfolio management and being disciplined and rigorous about how you rebalance your portfolio and make sure you don't have too much concentration risk with any one segment. So in terms of buying the dips, we like this idea of sort of selling the rips within those mega cap tech sort of segments of the market that have done so well and are riding this momentum wave, this enthusiasm, and then rotating into those relative value opportunities that I was describing. So, for us, it just sort of comes back to fundamental blocking and tackling portfolio management, making sure that we've got an appropriate mix of diversification and we're taking chips off the table when the opportunities present themselves.
Selling the rips. Is selling the rips when you hear, an investment thesis or theme making it to the Thanksgiving Day talk? Because now it's like, okay, all right, well, now that all of you know about it, it's probably been overbought at this point.
That's right. It goes back to the old taxi driver talking about Cisco back in 2000 kind of example, right? But same thing. You're talking about Bitcoin over Thanksgiving dinner, back in 2016, 2017.
Exactly. Yeah.
It kind of called the short-term top at least at that point. So just something to be mindful of.
Andrew, great to speak with you here today. Thanks so much for taking the time.
Yeah, appreciate it.
Andrew Gray, who is the Crescent Grove Advisors co-chief investment officer. There is another one as well here. Great to have you here in studio.
Appreciate it.
Stay tuned for more on Nvidia. At the end of the show, I'll be joined by our tech editor, Dan Halley, who's got the breakdown on the everyday use cases for Nvidia's AI chips ahead of that big earnings report. Now, for a conversation on fixed income in the year ahead, I'll send it on over to Rochelle and Bob over at Schwab Impact. Take it away.
All right, so here at Charles Schwab Impact, we're joined now by Kathy Jones, Charles Schwab's Chief Fixed Income Strategist. Here, obviously a lot of buzz around here at the moment, and especially a lot of buzz after the elections as well. A lot of people wondering then, what can they expect as we're looking at some of these trends that we're seeing, especially in long-term bond yields? What are you keeping an eye on at the moment?
Well, we have a whole sort of trifecta of policies that could have an impact and send yields higher, but we don't have any clarity around whether those policies will be implemented, how they'd be implemented, or what the long-term effects might be. So we have tax cuts. Those are probably a ways down the road, but that could increase the deficit and actually speed up an economy that's already growing at a pretty healthy rate, and that might give us more inflation. You have tariffs, which have been the big topic of conversation, and that can give us at least a one-time price increase as those imported goods are priced higher, and that's passed through to consumers, another potentially inflationary policy. But offsetting that is that it could slow growth because you get less business investment domestically if that happens. And then the third is immigration reform, which, if implemented as discussed, we could cut back on the size of the labor force substantially, up to maybe 8% of the labor force, and that probably would boost wages and slow growth as well. So we have all these policies, we have no clarity about them.
So, given that uncertainty, we're still watching bond yields rise right now. So we're looking at a probable case of maybe higher, the market's anticipating higher inflation, et cetera.
Yeah, exactly. So there's something called the term premium, and that is the extra yield that investors demand to buy long-term bonds and hold them versus just buying short-term bonds and rolling them over. So if you buy a 10-year bond, you want to get a yield that gives you some compensation for the risk that short-term rates are going to not do what the market expects, right? So what we've seen is a term premium, which is kind of a risk premium, has been moving up. It was actually negative last summer and fall, and it's moved into positive territory. It's not all the way back at the long-term average, so it could rise further, and that, I think, is the main driver between the rise in yields, along with the fact that we've had better than expected economic growth.
So then in terms of the domino effects, because we know long-term yields tied to mortgage rates, people hoping for some more relief on that front, what are some of the domino effects and what are some of the strategies that perhaps investors can use to counter them?
Yeah, so mortgages obviously very much tied to long-term rates, and that's the housing market has been kind of moribund for quite some time. When I look at it as an investor, there's a two-edged sword here. So yields are up, and yields are at pretty attractive levels relative to current inflation. So I look at that as an opportunity. I want to be in higher credit quality bonds. I don't want to go too long in maturity because that gives you a lot of volatility. You measure that by something called duration, meaning how much the bond price is going to move relative to inflation. But in general, you probably want to have a high credit quality a bond portfolio, meaning treasuries, other government-backed securities, investment-grade corporate bonds, municipal bonds, things with high credit quality, but not too long in duration, so you're not kind of caught up in the swings in the long end of the market.
So what about retirees who are looking at fixed income as a way to generate income in retirement? Do they need to reposition their portfolio?
Well, it depends on where they're starting, but I think they should take advantage of the current income that's available. We're looking at 5% plus in high quality bonds. That's a pretty good return over long, especially for a buy and hold investor, someone who's going to have it in their portfolio just to generate income. And the good thing about bonds is most of what you get is the coupon payment, the interest payment. That accounts for about 80% of your total return. So if you're a buy and hold investor, that's a pretty sound place to be during turmoil.
Kathy Jones, thank you so much for taking time. I know it's a very busy conference. Appreciate you taking the time.
Thank you.
Back to you guys in the studio.
All right, thank you so much to Kathy, Rochelle, and Bob. We've got much more coming from Impact in just a little bit. President-elect Donald Trump tapping Dr. Oz to oversee Centers for Medicare and Medicaid Services. Our very own Anjali Kamlani is here with more on this decision. Anjali, what do we know?
Well, we do know that Mehmet Oz is a pick. We know that he has run before for a Senate position and failed there. So he has had political ambitions. And we do know a little bit about his stance. So to lead the Centers for Medicare and Medicaid Services, that of course covers those two government payers, Medicare being the big one to keep an eye on because of the IRA drug pricing that was set in motion during the Biden administration, as well as what happens to Medicare Advantage. He seems to be a supporter of the idea of Medicare for all or expanding more of the private payer relationship with CMS. We know that area has really come under fire in the recent past with the government saying they're overpaying these insurers like Humana, Cigna, and the like, United as well, and CVS, those who have been playing in this field of Medicare Advantage. So that's something to keep an eye out for. Now, what we do know also is that tied, of course, with RFK Jr., that puts a little bit of a wild swing, if you will, on what the picks are. Analysts saying that they didn't quite see these two coming, or rather specifically Dr. Oz, television personality, someone who hasn't really been part of the conversations in recent weeks. We got one analyst saying, JPM's Lisa Gill, saying that CMS under Republican control would support Medicare Advantage, which, as I mentioned, is a good news for these companies. But Mizuho's Jared Holes saying healthcare appointments in the second Trump term are getting wilder by the day, just to get a sense of how these analysts and investors are looking at it. Coming down the line, we now know two. The most important one, of course, for the drug sector is the FDA. Who is going to be in that top spot, as well as the CDC now that we're looking at infectious diseases, generally speaking, like bird flu. So we do not know who those are, but I'm going to give you some names to just keep an eye out for. Dr. Casey Means, someone who has been pretty prominently paired with RFK, looking at lots of the ultra-processed food problems and other childhood disease problems. The State Surgeon General of Florida during the pandemic didn't really have that great a reputation, kind of going against the grain and going against the advice of what was going on nationally. Dr. Jay Bhattacharya, he's a Stanford School medicine professor and someone who was co-author of the Great Barrington Declaration during COVID. Marty Makary, also another one that, these names that are popping up, we really saw a lot of their platform during the pandemic and how much sort of the general scientific population was not in favor of what they were saying. We've got some other names as well, including senators, representatives, and some Instagram influencers as well. All part of the potential lineup of names that we could see in the coming weeks. So keep an eye here. And of course, I will be telling you when I find out more.
All right. We might hear more takes like Mizuho's, or other analysts might also lend their voice to the conversation.
Absolutely.
We will see. Thanks so much, Anjali Kamlani, breaking it down for us here. Well, attention all college goers or parents of college goers. The 2025-2026 FAFSA form is now open to everyone during beta testing. FAFSA forms are how colleges and career schools determine how much financial aid you're eligible to receive. This includes grants, scholarships, work-study funds, and loans. Up until recently, the form was only available to limited groups of students in beta testing that began October 1st. The Department of Education said last week that since then, more than 14,000 students successfully submitted their form. This comes after last year's rollout was littered with complications. A revamped FAFSA system last winter resulted in an initial 90-day delay to open the form and ultimately a 9% drop in submitting forms among first-time applications. More than 40 technical issues were identified with last year's rollout, according to the U.S. Government Accountability Office. But today, as part of expanded beta testing, the FAFSA form is now open to all, and here's what it means for you. Number one, students should start by signing up for a studentaid.gov account, also known as an FSA ID. It takes most people less than 1 hour to fill out the form. You'll need that FSA ID, your parent or spouse contributor name, date of birth, social security number, and email address, and you'll also potentially need income and asset information. Well, coming up, options trading for Bitcoin ETFs this year. We're diving into some of the top picks for your portfolio next. Grayscale is adding options trading to its Bitcoin ETFs today. This after BlackRock saw record interest in its iShares Bitcoin Trust on its first day of options trading. Joining me now for more, we've got Christian Magoon, Amplify ETF CEO, as part of this week's ETF report brought to you by Invesco QQQ. Christian, good to catch back up with you. Great to see you. So let's discuss this. I mean, this is a huge move potentially for Bitcoin and crypto more largely, but what is the significance of us now looking at Bitcoin related assets being able to be traded in ETF form?
Yeah, Brad, great to see you. And yeah, it was a big day yesterday for the Bitcoin community, as well as just Bitcoin ETFs, to have almost $1.9 billion of trading volume notionally in IBIT ETF options was a big deal. It's a great start, and a variety of other Bitcoin ETF options began trading today, including the Bitwise ETF Trust BITB. There's a lot of interest here, and what this really allows Bitcoin investors and Bitcoin ETF investors to do is hedge their positions if they want to, or potentially magnify the upside of their positions through using regulated options on the ETFs that hold these physical Bitcoin. So a great way to really institutionalize Bitcoin ETF trades, both bull and bear, for investors of all types, whether it's institutions or retail investors. So I think this is a good thing overall for Bitcoin adoption as well as Bitcoin ETFs.
What's the decision tree? Like when do you decide, when should you kind of qualify whether or not you should just be holding crypto or holding Bitcoin versus holding Bitcoin ETFs versus trading options on Bitcoin ETFs?
Yeah, that's a great question. I think it starts with, where is the assets that you have? So, for example, if you're in a traditional brokerage, or a retirement account, you're going to be looking for a regulated way to own these, which would likely be the Bitcoin ETFs. And then from there, depending on your qualification, you may or may not be able to buy options. That there's a certain gating process to that. For traditional OG Bitcoin investors, they're certainly using platforms like Coinbase and maybe bringing their Bitcoin on cold storage. However, they may want to hedge that exposure or may want to magnify that exposure through a regulated market like the Bitcoin ETF option market. So I think it all depends on where your money's at and what your perspective is in terms of how much you trust different forms of market, from self-custody to going to just a Bitcoin or a crypto-only platform, or to regulated exchanges in the form of Bitcoin ETFs.
And so, all of this considered, you've got another cutting edge technology that people are, investors paying close attention to, and that is artificial intelligence. And the number of AI ETFs that are out there now that have even more weighting towards some of these semiconductor names in them. What are you seeing in the makeup and how some of those weightings are playing out and attracting the eye of investors?
Yeah, so not every semiconductor or artificial ETF is created equally. For example, you can look at certain semiconductor ETFs and see Nvidia be double the weight of that ETF versus another ETF. Also, if you look at artificial intelligence ETFs that might comprise semiconductor stocks, maybe even hardware, software stocks, you can see also massive weightings to individual companies that have performed well over the past. We really think for long-term investors, you want to take a diversified approach when it comes to artificial intelligence. It's sort of like the internet revolution. There were some early names that did quite well, but over time, some upstarts became important to own. Also, some different market segments emerged. So we really believe the approach is taking an equal weight to the three kind of pillars of artificial intelligence, which is software, hardware, and semiconductors. We have an ETF, AIVC, that equal weights those three different segments, and then equal weights the underlying stocks in those segments, really to give you hopefully a sleep well at night or more diversified approach to investing in artificial intelligence, because as we know, those companies can have a lot of volatility.
Christian, just lastly, while we have you here, and very quickly, of course, there have been a lot of retail companies to report this week. We've had the opportunity to have on Walmart. Our executive editor spoke with Target's CEO as well, and we've ultimately been hearing about more of a rush towards some of the digital investments that retail companies are making. How can investors think about this thematically and play that on an ETF level?
Yeah, so we've been investing in this space through our ETF iBuy, the online retail ETF. going back to 2016. And we really believe the biggest area of growth in this segment is online retail. So we think that you need to invest in the retail side where companies are investing the most in online retail and seeing the most sales growth. You know, Brad, holiday shopping season is coming up. We think that holiday shopping will grow by about 4% this year. However, when you look at online retail shopping in the holiday season, we expect about double that growth rate, about 8%. So we think online retail is the sweet spot. We think iBuy is the way to play it. And again, another way to own a diversified basket of companies that are primarily engaged in online retail sales and marketplace transactions.
Christian Magoon, Amplify ETF CEO. Good to catch up with you. Thanks so much for joining us here on Wealth.
Thanks, Brad.
Certainly. Coming up, everyone, your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We are 2 hours into the trading day. It is time for Yahoo Finance's market update. Stocks all in the red here in the morning session as investors await earnings results out from Nvidia. Taking a look at the Dow down 160 points roughly, S&P 500 down 47, and the Nasdaq down about 200 points there. Here are 3 trending headlines you need to know at this hour. Bitcoin hitting yet another record. The price of the crypto asset rose above $94,000 as investors wait early options trading on Bitcoin ETFs. Options on BlackRock's iShares Bitcoin Trust ETF began trading on the Nasdaq Tuesday, with options for Grayscale and Bitwise ETFs launching today. Taking a look at shares of Roku, under pressure here after ad tech firm The Trade Desk announced it is building its own connected television operating system, injecting new competition. You see shares there down nearly 8%. The system known as Ventura is set to roll out in the second half of 2025. And shares of Williams-Sonoma soaring in this session. Take a look, they're up nearly 30% on strong quarterly results. The home goods retailer reported improved sales and market share gains. The company's board approved a new $1 billion stock buyback plan back in September and now expects full-year revenue to fall by 1.5% to 3.5%. That's slightly better than the range projected 3 months ago. The stock is on track for its second largest one-day rally. That is your Yahoo Finance market update to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Much more to come here on Wealth when we return.
And emotions can drive decisions about money, and we're only human after all. But how can investors use behavioral finance to their advantage? Let's send it over to Rochelle and Bob at Schwab Impact.
That's right, Brad. We're joined by Omar Aguilar here. He's Schwab Asset Management CEO and CIO. Thank you so much for taking the time. Now, we've talked about behavioral finance, but animal spirits, things that can drive your investment decisions purely based on emotion. How does that tend to show up in environments like this?
Well, this is, behavioral finance is fascinating and it's great. And by the way, welcome to Impact. Hopefully, this is great. In many cases, what happens is you actually have animal spirits tend to be one of the typical behavioral biases that people have when they see things going in a certain way. Herding is a typical one. What that means is that you don't want to be left behind. And that's all foundational on who are as humans. As humans, we don't want to be the ones when the herd is moving along. That's a very natural evolution part of our brain that allows to protect us for just being together with some others. So the situation related the last few years about the Max 7 is a perfect example. Everybody, there are certain companies that people didn't know existed, 5 years ago, and today they're talking about it. And mostly because everybody wants to buy in, everybody wants to go in. Another example is crypto. Everybody talks about crypto and Bitcoin and situations that happen and how these things may revolutionize the world and everything else. Well, in many cases, when you look at the economic foundations and the financial foundations of what drives it, it just doesn't make sense. But as a human, your natural emotional piece is, I don't want to lose, I don't want to have, and that's what they call the FOMO. You don't want to be, you have this fear of missing out that is clearly a part of it. And what makes it worse is that now we have social media. And now we have social media that is in a way bombarding us with information all the time. And it's very typical. I see that I have teenagers, I have 3 teenage daughters. And it's amazing how they tell me, hey, how come we don't go to Hawaii? How come we don't have to Europe? How don't we do this? Because they see that on their friends. Right. And that's a very typical animal spirits because they only see that positive. They don't see the other part.
It's true. It's like, do you have the Hawaii money? How much planning have you done for this?
Exactly. But it's that part of like, I don't, if they're doing it, I don't want to be the only one not doing it. And that's, I think, a big part of how, investors make decisions, which in many cases could, affect them, down the road.
Yeah, Omar, a lot of folks don't even know they have these biases. I focus on retirees, and they have a fear of spending once they get to retirement. Is that a behavioral bias? And if so, what can they do to sort of overcome that?
Yes, and that's definitely the case. And there's 2 pieces that go to that. One bias that is typical is called risk aversion. And the other one is, it's it has a more scientific name, but, it's more known as paralysis. And paralysis is a very typical, bias that people have as they get closer to retirement and in retirement. And what that means is that you just don't want to look at it. In other words, you've been saving money, you have money in the bank, and all of a sudden you see things that are happening, positive or negative. You don't even want to open your bank account. You just leave it alone, just hoping that things are going to be okay. And when that's happening is that people tend to be over-allocated to cash, over-allocated to short-term instruments because they're worried that they're going to lose that money. Now, what they don't know, and what in many cases the challenge is that by doing that, they're taking more risks than what they are if they were paying attention. Because in many cases, inflation, which is the biggest sources of risk for somebody in retirement, is basically dragging that if they don't necessarily are invested above the inflation. So in many cases, that idea of paralysis and not spending money is actually the same thing as not investing the money in the right places. In many situations, a big part of what advisors and others do is try to create a plan that systematically targets the income they're going to need in retirement, so that they can spend what they need and they can get the income they need without necessarily having to exhaust all their money. But that step is a behavioral component where people don't want it because they're so averse at potentially losing any of their capital. And again, they don't necessarily balance all the risks together.
So to that point then, 1, how do you recognize when you're being triggered by biases? And 2, how do you counteract it? What are the strategies?
Well, that's a great question. And the answer that I have always provided over these 20 plus years I've been doing behavioral finance is that we all have biases. We are all human. There's 2 parts of the brain that interact all the time. It's the amygdala, which is the more emotional bias, which is, is what the flight to safety. It's just, who we are. Like if there's an alarm right now, our instinct will be to run away. And then there is the frontal cortex that basically allows us to just be rational. And that's the one that says, hey, we're going to be fine. We're going to allow us to do that. And both of them interact with each other all the time. And both of them can actually potentially have. So all of us have biases. Everybody, like even professional traders, even professional investors, we all have bias. What we need to do is recognize what are the biases that trigger us the most. What are the things that creates anxiety in it? In some cases, it could be FOMO. In some other cases, could be risk aversion. In some other cases, could be recency bias. If people feel that by looking at a headline, immediately they have this anxiety of like, oh my God, I got to go to my account and I got to trade. That can easily give you a sense that you may be affected by some of the biases. At Schwab, we have created a tool that we call Biagnostics. Again, it's a little bit of a marketing, name, which allows you to diagnose what biases may be more common to you. And it's a combination of, emotional and cognitive biases that link all together. And also we provide, some techniques that allows people to just mitigate some of those biases, which is in many cases being systematic about investing, information, creating a program that allows us, and in many cases, talk to advisors. Talk to an advisor, talk to somebody that can listen to you, especially when you have these emotional triggers that will potentially lead you to do things that may not necessarily be in your best interest.
It's certainly important to have both of those pieces in there, so appreciate you bringing that up, and I'm sure we could all check it out. Appreciate you joining us. Omar Aguilar, thank you so much.
Thank you, Omar.
Thank you.
Back to you guys.
All right, thanks so much, Rochelle and Bob. Appreciate that. Well, coming up, we've got much more, and after the break, I'll send it back over to Rochelle and Bob at the Schwab Impact 2024 conference. They'll speak with Gabelli Fund's co-CIO, Chris Marenghi. Then we'll dig into two big stories with our reporters, EV demand and Nvidia's chips and how they power things that you're already using. Stay tuned here on Well.
We are live here at Charles Schwab Impact, getting the word on the ground from a lot of the advisors out here. And we're now joined by Chris Marenghi, Gabelli Fund's co-CIO here. So a lot of things to get through here. I, of course, want to first start with Nvidia. They're reporting after the bell. Now, you don't own it as a value portfolio. I mean, look at the stock price at the moment. But what are some of the best ways to play AI beneficiaries outside of Nvidia?
Yeah, so our growth team does own Nvidia. We follow it, obviously. It moves the markets. But we're trying to find other ways to play AI. And one of them has been power, and that's been fairly popular. Data centers require enormous amounts of power. There are other demands for power, including EVs and crypto mining. And so that is causing an increase in power demand for the first time in decades. And so many of the just plain old utilities are going to be beneficiaries of that.
I know you had
plain old utilities, but nuclear energy is now sort of at the forefront of the discussion as we think about how can we power AI mining, AI and crypto mining.
Yeah, absolutely. And obviously we're all doing this with an eye to the climate. Even with the new administration, I think you're going to see this continue because you're seeing companies like the big data center owners want their power to be generated in a sustainable way. And nuclear power, although controversial, doesn't emit any greenhouse gases. So technology's evolved, the big nukes have gotten safer, and there's also this innovation of small modular reactors, which we'll probably see over the next decade, and that'll help fill the hole for sustainable power.
So what do you do in terms of how you position the portfolio? There's still a lot of unknowns as to, as we said, perhaps more nuclear coming online at some point to power these things. How should people be viewing these sorts of investments?
Well, we're bottom-up investors. We follow these industries, have followed them for decades, know the companies, know the regulators, know the clients, et cetera. So, we look at individual utilities in that particular case, and who's in a good regulatory jurisdiction, who has spare capacity, which ones are well run and have good capital return policies. And so we pick those. And some of the ones that we like are Alliant Energy, which is in Wisconsin and Iowa, the old PNM, which is in Texas and New Mexico. And then of course there's NextEra Energy, which is one of the biggest in the country, in the world, and among the biggest renewable generators in the world.
Yeah. Do you worry about how tariffs, possible inflation, rising interest rates affect some of the stocks that you're picking?
We worry about everything. We consider everything. Obviously, that's the question that we're asking today. Post the election, there's good and bad from this administration. We expect some deregulation and perhaps an increase in growth. On the other hand, what are the chances that the tariffs actually do come into play, and to what extent? So we're looking at how that affects the supply chains, and who would be affected most and who might benefit. That's the other side of the coin. So we're focused on domestic companies in particular in this environment, just because they're probably going to be less impacted by what happens in the international scene.
And we continue to see a lot of M&A, especially in the media space. What are the expectations there? And are there any companies that you have your eye on that investors perhaps should be paying more attention to?
Yeah, so M&A has been obviously a bit moribund for the last several years, partly because rates have gone up, partly because of the antitrust situation in Washington, and that's likely to change for the better. So we've got a lot of investment bankers who are very excited at the Trump administration, and we think M&A will begin to pick up, particularly amongst private equity firms who have been on the sidelines for the last several years. So we think there'll be more activity. Technological changes in consumer behavior are driving M&A, companies to get bigger, particularly in the media space. So, big announcement today, Comcast spinning off their cable networks business. We think that's going to be a consolidator, and we'll see consolidation in that area.
Yeah. When you think about the decline in publicly traded stocks, does that worry you in terms of the trend toward the falling number of publicly traded and the rising number of private assets?
There's still plenty of companies to look at, and plenty of companies that nobody cares about. I mean, if you look at just one crazy statistic, the entire market capitalization of the Russell 2000 is equal to one company, that's Nvidia. So there's a lot of companies to look at. Obviously, we look at new companies, and we think IPO market will see a resurgence, and we'll have more companies to examine. We've also got spin-offs, which is a great source of ideas for us.
Any just one quick under the radar stock that you think people should pay attention to?
I don't know if this is under the radar, but a lot of people don't realize is we can own a baseball team. We don't have to be a billionaire. You can go out and buy one share of the Atlanta Braves Baseball Club for around $40. That values the Braves at about $2.2 billion. The Braves are worth at least $3 billion. They've got a great stadium and multi-use real estate development around it. I think the stock, stock is 40 now. We think it's worth well into the high 50s, and think that at some point a really rich owner, buyer will come and take that company private.
As a Nats fan, I don't know if I could do that, but I do appreciate that call out there. Chris Maraghi, thanks so much for joining us here on Yahoo Finance.
Thank you.
Back to you guys in the studio.
Excellent stuff from our own Rochelle Akufo and Bob Powell. Thanks for bringing us that interview. And don't miss our continued coverage from Schwab Impact. Rochelle and Bob will be back. And Rochelle's going to have another great lineup of guests, including incoming Charles Schwab CEO Rick Wurster, Stewart Partners Head of Wealth Management Jeff Gagnon, and Schwab Chief Global Investment Strategist Jeffrey Kleintop. All that and much more. Tune in tomorrow at 11 a.m. Eastern Time. Well, shares of electric vehicle maker NIO reversing losses today after reporting falling revenue and a wider net loss in its third quarter. Pressure to lower prices in the highly competitive market weighing on the company. And here in the U.S., a cloud of uncertainty hangs over the sector. President-elect Donald Trump vowing to repeal a key tax credit that's helped accelerate the transition to clean vehicles. Here with more, we've got our very own Akiko Fujita. Hey, Akiko.
Hey there, Brad. Yeah, that tax incentive included in the Inflation Reduction Act specifically gives consumers a $7,500 credit to purchase a new electric vehicle or plug-in hybrid, a $4,000 credit for a used clean vehicle, and then additional credits here for a leased car. Donald Trump vowed to cancel that on the campaign trail, and Bloomberg reports that could dent future EV demand by as much as 27%. The report cites research out of UC Berkeley, which says annual EV registrations in the U.S. could fall by 317,000 cars. That's a sizable dent when you consider new electric car registrations totaled 1.4 million in 2023, according to the IEA. Now, analysts say car makers most reliant on the U.S. market would see the biggest impact from any repeal of the EV tax credit, which would make their vehicles more expensive. Piper Sandler specifically says Tesla, which relies on the U.S. for about a third of its total deliveries, would see a 20% decline. Rivian, which gets 90% of its revenue from the U.S., would see a bigger dent when you consider more than 40% of Rivian owners lease their vehicles, presumably with credits from the IRA incentive. The Detroit 3 would also see declines in EV sales, but they may be more protected because of the diversity in their cars. Piper Sandler saying specifically GM, Ford, and Stellantis could see a boost in margins from its gas-powered cars. Morgan Stanley analyst Adam Jonas says he expects the EV adoption to rise long-term, even if the EV tax credit phase-out is inflationary on the front end. But it is important to remember that Trump would need congressional backing for any changes to the IRA, so he can't unilaterally eliminate those credits, Brad.
All right, excellent reporting and breakdown. Our own Akiko Fujita. Appreciate it, Akiko. Let's turn now to the world of technology. Time for Tech Support, a segment where we bring you the latest news, tips, and advice around the latest and greatest in computers, phones, tablets, and more. And today, we're talking Nvidia, ahead of their highly anticipated earnings report after the bell. Yahoo Finance's Dan Howley joins me now. Dan, we've all heard about Nvidia's GPUs, but how are we actually using them in our everyday lives?
Yeah, so I think the big thing to point out is that this used to be primarily a video game company. And so these GPUs that we talk about, or now we call them AI chips, depending on the application, but the GPUs sit in a desktop computer, in a laptop computer, something along those lines, and they help power a litany of applications, primarily gaming when it comes to the things like their RTX series. I happen to have an RTX 4070 Super. It was $700 and a great investment, according to my bank account. Anyway, I also use laptops that have plenty of these cards inside. Primarily what you're gonna do is gaming, but then what they're starting to do now is talk a lot about AI PC and how these companies are going to be powering AI applications with these built-in GPUs or these secondary GPUs. And so I think that's something that a lot of people need to understand is they came out with the original GPU in 1999. That's when they said they created the first graphics processing unit. You could see it there. And then they've just been iterating on this ever since, making them faster and faster. And so
and smaller.
And well, no, bigger. Now they're huge. Yeah.
GPUs,
my God, they're like this big. Yeah. Okay. I mean, but so you're going to continue to hear about this AI PC movement. And so NVIDIA is going to be jumping on that as well. And the big deal here is, can it power on-device AI? And that's really going to be where you start to see Microsoft push Windows. You'll see different OEMs push their own AI PCs, and NVIDIA is going to be at the forefront of this for sure.
You know, as we're sitting here looking at the RTX, is this the one that you have?
No, I have the 4070. That's like $1,500. That's
okay,
yeah, that's
right.
a lot of money.
Okay, and so as we're thinking about this, I mean, there's the larger question of how long this demand can last for.
Yeah, I think for the gaming segment is going to continue to just keep on trucking, right? Gamers have been big about getting the best graphics forever. I do it myself. I upgrade every 5 years and I buy a new $600, $700 card. So that's not going to disappear. Laptops, the same difference. There's a little Baldur's Gate here, beat that game. But the AI PC, I think, is where we're gonna start to see the kind of pickup. And we'll just have to see if consumers are really drawn to that or not.
Dan, a lot to keep tabs on in this report. Can't wait. Yahoo Finance's own Dan Howley with the Tech Support. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. Stay tuned for Market Domination coming up 3 p.m. Eastern Time.